Welcome everybody, welcome. I'm gonna let a few people come in the live stream. What's up everybody, what's up? I hope y'all got y'all pen and paper for this one. Take notes, I hope y'all got some note-taking instruments. Because as you see in the title, this is gonna be a masterclass of TA. I'm gonna tell you why I'm doing it right now. But I'm gonna let a few people come in the live stream. What's up, Scott? Shout out to Alaska. Shout out to Gentel. Let a few more people come in the live stream. This one gonna be a little different today. Y'all hit that like button if you're new to the channel, subscribe. Y'all get them likes up. Y'all hit that like button. This is going to be one that you want to refer to, watch over and over. So this one is going to be very detailed. So if you want to learn technical analysis, you want to learn how I do it on a professional level, then you might want to take notes. And at the end of this one, you might want to go watch the replay. So I'm gonna allow a few more people to come in the live stream before I get started. And as you can see, this is a technical analysis masterclass, and then you're getting it for free. So I'm gonna go into great details for the free. Y'all get them likes up. I got 11 people in the building. Y'all hit that like button. What's up everybody? Today on this one, y'all gonna wanna pay attention. If you can't pay attention, then you might wanna come back and rewatch it. Today I'm gonna get straight to the point. This is something I've been needing to do. So as you can see on my screen right here, I got a naked XRP chart. Y'all see this? It's a naked canvas. XRP sitting on the monthly time frame. What I'm doing is I'm redoing my charts. I need to redo my charts. Why? Because this XRP chart that I'm currently on, this is a crypto.com. This is a price feed from crypto.com. They have more data. And I've been needing to do this. So I said, if I'm gonna do it, I might as well teach how to do it. I might as well show y'all how to do it. So look at my old chart over here on the left. This was my old chart from Bitfinex. I don't use Bitfinex. I've just been using their charts. And as you can see, look all the way over to the left. The data begins on May 2017. That's when their data begins, May of 2017. But if we come over here to this crypto.com chart, they have more data that goes all the way back to 2013. And also watch when I drop down to the 1 minute time frame. I'm gonna drop down to the 1 minute on this naked chart right here. 1 minute. You can see how price action is pretty much clean. Y'all see that? But watch when I go to my old chart on the 1 minute. I'm gonna drop down to the 1 minute. You see how gapped it is. It's skipping. The price action isn't really clean once I drop down the lower time frames on the Bitfinex chart. So when I drop down on the 1 minute chart on the crypto.com chart, price action is cleaner. So that's why I'm switching over to a new chart, because the data feed has better data. So while I do this, I'm gonna go ahead and do a top-down analysis. I'm gonna show y'all how I break down my charts and how I analyze the market. So this is gonna be a master class for people who are new, people that don't know all the details that go into this. I'm gonna break it down and I'm gonna get straight to the point. So this chart over here, I'm deleting it. I'm gonna delete it and I'm gonna start fresh. And this is how you keep, you wanna do this pretty much every month. This is how you stay up to par, stay sharp in your analysis. So you wanna do this every month when you're first starting out. Y'all hit that like button. For everybody that's coming in, this is gonna be a different live stream. I'm doing a master class. So everybody should be paying attention. Everybody should have some type of notes. And if you can always refer back to this live stream. You can always refer back to this live stream if you missed anything. So I'm gonna give you great details. I'm gonna go down. I'm gonna give it to you how most people wouldn't do this. Most people charge for this. So let's come over here to my new chart. Go out to the monthly time frame. So what I'm gonna do is I'm gonna start from a top-down analysis. Top-down analysis is going from a monthly, weekly, daily, 4 hour, 1 hour, 15 minute, 5 minute, 1 minute. That's what I'm about to do. So you can see I'm starting from a top-down approach. I'm going from the top-down approach. Right now I'm gonna start on the monthly time frame. The monthly time frame is a long-term chart. The institutional capital pushes price around based on the higher time frame charts. So what you do is, by doing a top-down analysis, you're getting in sync with order flow, meaning the direction of price. That's what you're doing. Yeah, it's free game. Y'all take notes, pay attention. This is gonna be a master class. I ain't gonna do too many of these. So those of y'all who are here and y'all taking it, who are watching, take it in, and you can refer back to this. So I'm gonna give you a top-down analysis. In these terms that I'm giving you, like top-down analysis, it's gonna be different terms that I'm giving you. So you wanna note those terms, and if I explain what those terms are, or if y'all got any questions, y'all can hit the comment. This is gonna be a master class. Most people won't do this. So you wanna digest the terms, and you kinda wanna understand what I'm doing, and you can always go back and watch the replay. So I'm starting with a top-down analysis approach. I'm starting on the monthly time frame. I'm gonna work my day down. I'm gonna work my way down from a monthly, weekly to a daily. So y'all follow me. So on the monthly time frame, since this is a long-term chart, I want to look back at least 9 to 18 months. So what you do is you want to come to the current month that we're in. We're currently in December 2024, the last month of the year. You pretty much want to look back at least 9 to 18 months. So how do you do that? You can count the individual candles, or to make it simple, this is TradingView, by the way. I'm using TradingView for y'all who aren't familiar with the charting platform. This is TradingView. This is the most premier charting platform that there is on the market. So what I'm about to do is I'm about to take this ruler over here on the left side of your screen. On this charting platform, you got tools that you can use. I use basic tools. I'm not using nothing that's over the top or nothing that you can't understand. I'm using trend lines and boxes. That's all I pretty much use. And I'm reading price. Y'all get them likes up. Share the video. Subscribe if you're new. So I'm about to look back 9 to 18 months on the monthly time frame. I'm starting on the monthly. I'm gonna take a ruler. You can lay it on directly on top of the current candle, which is December. And you can start either below it or above it. It doesn't matter. And you're gonna take this ruler and you're gonna measure back 9. That's 9 months right there, 9 to 18 months. But I want to look back 9 months. 9 months. I'm gonna go back. I'm gonna go out a little bit further to 18 months. Boom, right there. If you look down at the bottom of the screen, it says 18 bars, or pretty much 18 candles. Each one of these candles are a month. Take a month to complete. And it'll give you the days, how many days that's been. It's been 549 days. So if I'm looking back 18 months, it's been 549 days in the market. That's how much perspective I got. And you do this pretty much every month, at the end of every month. So we got 14 days that's left in this month. You want to do this analysis over and over. You want to repeat it every month. At the beginning of the month or the end of the month, you want to repeat this whole analysis. So what I'm doing is, when I look back 9 to 18 months, I want to pretty much see what the market structure is. What has the market structure been in the past 9 to 18 months? Market structure is pretty much, okay, we've been consolidating and then we've been trending. So we started off in the consolidation in the past 18 months. Now, before I go any further, all this data to the left of the after beyond 18 months, this price action, okay, let me start over. Take a ruler. Let's go out 18 months. Right there, that's 18 months worth of price action. Everything to the left of it is still relevant, but we don't need to use all that right now, especially if we was caught in a range. You just want to view price from this perspective, but everything out to the left of it is still relevant. But when you're starting off your analysis, you want to pretty much have a framework. You're building out a framework to work with before you start looking back to relevant levels in the market. So I'm starting you off at 18 months. You want to determine what the market structure was. Where's the highs and where's the lows? You can see we're in a consolidation market structure. We broke out of it, and that's what you determine. So we went from a consolidation. Y'all see this? This is a consolidation profile where the market is trading sideways. And when the market is consolidating, it is building orders above and below old highs and lows. And what it's doing is it's chopping traders out the market, people trying to go long and people trying to short it. And they're accumulating, the market makers are allowing large orders to build up inside of a consolidation. And then after consolidation, we get the expansion. That's what's going on. So that's the market structure. Right now, currently, we're expanding. So another term for expanding is trending. Expansion is the same thing as trending. So what direction are we trending? Are we trending bullish or bearish? We're trending bullish. So the market structure was in the consolidation in the past 18 months. And then last month in November, we broke out and started trending bullish. So market structure currently is bullish. Y'all understand? Hit a 1, leave a comment if y'all understand. Y'all can engage the comments. Y'all got any questions? I answer them real quick. But this is a masterclass, so you should be taking notes. You should be paying attention. All right, I got engagement. People paying attention. Okay, cool. Again, if you missed it, if you missed anything, or you just coming into the live stream, you can go back and watch. You can always go back and watch. This is gonna be up on my channel, and you can use it as reference. So I'm starting you off at the past 18 months. You want to define what the high and the low was. So the low in the last 18 months was this low right here, and the high is up here in the current month. Low right here. So let me do this again so you can see. That's 18 months. You want to identify the low and the high. I'm not going to draw it out right now, but if you just look back 18 months, there goes the low, there goes the high. Market structure is trending bullish. So we define market structure. Next, what you want to do is you want to determine the market profile. So what a market profile is the current condition. Is the market consolidating? Is it expanding? Pretty much what I just went over. Pretty much market structure is pretty much where's the highs and the lows. And the market profile is, are we trending bullish, consolidating? Are we retracing? You wanted to determine the profile. So there's only 4 profiles in the market: consolidation, expansion, retracement, reversal. That's all the market does. So I want y'all in the comments to tell me, what market profile are we currently in? Y'all let me know in the comments, what market profile are we currently trading in? And I just gave you 4 of them. Okay. If y'all missed that, Sneaky just gave y'all the answer. Cheap suit. We're not selling. We're not selling right now. Where do you see selling at? What is the current market profile? After coming out of consolidation in the past 18 months, we broke out. There's no selling. There's no sell program. But if you flip it around, there you go, Malcolm. If you flip it around, we're in the buy program. There's no sell program. It's a buy program. That's just another advanced term for. That's an advanced term for a trending market, bullish. But it's the same thing. It's in the buy program. We broke out of consolidation. Now we're in the buy program. So, okay, y'all got that? So your focus is in the past 18 months. You can see that we broke out. We started taking out old highs. We already know what's above old highs. Liquidity. Price always seeks liquidity in the market. So y'all see this breakout in the market. We started breaking out after breaking the consolidation. We started expanding, taking out old highs. Y'all see these old highs to the left? They're targeting liquidity left behind by the market makers. Now, before I continue to lower time frames, you want to identify, this is a new term for y'all. This is a new term. I'm going to give it to y'all. You want to identify the PD arrays, like PD arrays. What are PD arrays? PD arrays are premium and discount arrays. The market trades from a premium to discount, discount to premium. It's always going to have that built into the market. It goes from what? Discount down here to a premium. But how do you find the arrays? The arrays are what? The fair value gaps, the wicks in the market, the liquidity pools. Those are the arrays in the market. They're premium and discount arrays because you can find fair value gaps below the market, which makes that a discount. You can find a fair value gap above the market, which makes that at a premium. How do you define what's above and below the market? So here's current price. Anything above it is premium. Anything below it is a discount. Y'all get that? That's called a PD array. So you can write that in your notes. They're premium and discount arrays in the market. So I know y'all been hearing me talk about fair value gaps and all that, but you put them, I'm referring to them whether they're in a discount market or in the premium market. That's how I refer to them. I might say, hey, this fair value gap is at discount. Well, that's a discount array. Or I might say this fair value gap is at a premium. That's a premium array. For example, look at this old high right here. This is what? Buy side liquidity. It's a liquidity pool in the market right there. That's a liquidity pool. When we was down here in the market, this was a premium liquidity pool above the market. Or even right here, when we was right here, this was a premium liquidity pool. So there's different PD arrays. I have over a dozen PD arrays. I got fair value gaps. I got order blocks. I got liquidity pools. I got breaker blocks. I got propulsion blocks. I got volume imbalances. Some of these terms you already heard before. That's just more advanced. I'm just giving right now on this masterclass, I'm going to give y'all a basic framework that y'all can use to build out the market. And then later on, once y'all get that, I will be more advanced and showing you the different PD arrays in the market. You said, can I repeat that one more time? Repeat what? What did you miss? And let me know if I'm talking too fast. Can y'all hear me clearly? How's my audio? Is the music too loud? Y'all let me know. Steve, expansion. The market always starts in the consolidation, expansion, retracement, reversal. There's no contraction. Okay, you said define PD arrays, and you're spelling it right. PD array. The P stands for premium. The D stands for discount. The P stands for premium. The D stands for discount. Okay, I appreciate it for the sound check. So the market is always looking for some type of PD array. Above the market, premium. Below the market, discount. As you can see, okay, now follow me. We're still on the monthly time frame. Look how, when I'm doing my analysis, this goes fast. But when I'm teaching and you're trying to learn, look how long I'm taking on the monthly time frame. I haven't even dropped down yet. So again, if I look back the past 18 months, I'm gonna start on the current candle and go back 18 months. When you want to start on the monthly time frame and look back 9 to 18 months. What was the market profile in the market structure? Market profile was in the consolidation. Y'all see this? When we was in this consolidation in the past 18 months, above the market, there were PD arrays, premium arrays. How do you further define the PD arrays? Where they're specified. To be more specific, there's liquidity pools, which is old highs. There's fair value gaps. Once I drop down to lower time frames, like on the monthly, you will be able to see. On the monthly, you can't see, but once I start dropping down lower, you can further define different PD arrays. But right now, the most cleanest PD arrays on the monthly is the fair value gaps. The liquidity pools. And anything below the market in the past 18 months, for example, look all the way over here back. We're going to refer. Hold on. Let me do this right quick. Go back to 18 months. Right here. That price action right there is the 18 months. What discount array did we trade into? Well, there's really none that we can define. So that's when you can't define any PD arrays inside of that 18 months, that's when you start looking back further months. So the nearest one, the discount below the market is, let me highlight it. Let me highlight it right quick. 1 second. See this fair value gap? It's a small one. This is a monthly fair value gap. Y'all see that? That's a discount PD array. And you further define it by what kind of PD array is it? It's a fair value gap. It's a monthly fair value gap. So it has more significance than the lower time frames. So when you're on the higher time frame is more significant because that's where institutions are pushing the market from a higher time frame. So how many times did this small fair value gap get touched? 1, 2, 3, 4, 5. Y'all see that? They touched it 5 times. And where was it at? It was below the market, which makes that what? A discount fair value gap or a discount PD array. And then once we was in this consolidation right here, what was above the market? Premium arrays. So this is what I'm talking about, where the market goes from discount to premium, premium to discount. So again, 18 months, right here, 18 months worth of price action. This is when we was consolidating. That 18 months go all the way back to June of 2023. That was 18 months ago, June of 2023. And you can see how long price was in the consolidation. This is a long-term consolidation in the market. And then inside of all that, they got little small gaps that price was referring to. But look at the wicks. When we're in a tight consolidation like this, what we're doing is they're looking for the liquidity. When price is consolidating like this, I really don't focus on fair value gaps like that. What I'm watching for is Where's the liquidity? Because we all know that the liquidity is where the orders are. So you want to start highlighting old lows, like right here. You see that? And I remember scooping this up right here. This was the 4th of July weekend of this year. So I remember that was my last buy for XRP. When the market dropped down, look where it dropped down to. It dropped down into this fair value gap, which is a discount PD array, sweeping out old liquidity below this low right here. Below it is the pending orders. So that was the last time XRP dropped to 38 cents. They dropped price, swept the market, accumulated, and we haven't been back down there since. So my last buy order was at 38 cents for XRP. I had to take advantage of that, but guess what? Look how accurate that is. Look at the precision. Look at the precision in scooping that up. Taking a sniper shot right here at that low. Y'all hear one if y'all paying attention. I'm veering off, so I need to get back focused. That's how you define what a PD array is. So I'm gonna remove some of that because it's not relevant to me no more because we're trending higher. Okay, I appreciate it. If y'all new to the channel, hit that subscribe button. This is a master class in technical analysis. That's what is going on. We're unlocking algorithmic price action. So since that we have expanded, which we're trending higher, or a buy program, we have bust out. We have started trending higher. We broke out of this consolidation. All of this 18 months is really no longer relevant to me because I don't see us coming way back down here because after consolidation, we go into an expansion model. We're not referring back down here. They're not going to bring it back. And what also, you got to follow along with the narrative. All these good things going on with Ripple and XRP and the narrative in the market. So there's no need for institutions to push price way back down here. We have left this phase. We're not coming back down here. So now I have to start looking outside of that 18 months. Where are the arrays outside of that 18 months? Because you can see inside of this 18 months right here, we have broken this high right here. And now we're trading outside of that 18-month window. And we have been attacking old highs to the left, seeking the liquidity in the market. So look at this old high up here. I'm going to draw this trend line over here. We all know this is the all-time high in the market. I'm going to identify that because that's a premium array, which is a liquidity pool, a buy-side liquidity pool above the market. So what I want to do now, because this is my chart that I'm redoing. This is a new chart. I'm switching over to crypto.com. Reason why? They have better data compared to the old chart that I was on. This chart over here. The history stopped in 2017. Crypto.com's chart goes all the way back to 2013. And on lower time frames, the price action is cleaner. So let's go up to this high right here at this liquidity pool. I'm getting the high of this candle right here. The high is $3.31. So now I want to calibrate my trend line, which is the liquidity. I want to calibrate it to this high. How do you do that? You click your trend line. You come to the settings. You can add a text. So for example, I'm going to put all-time high, $3.31. I want to put it at the top and at the right. I want to make the number a little bit bigger. And then I want to go to coordinates. So at coordinates, this is how you become real accurate and get your trend lines and all your PD arrays accurate, like with precision, so that you won't miss a tick or a point or a drop on your charts. You can know exactly where the mark when price eventually gets up here, it's going to hit it with precision. So I want to calibrate it. The high is $3.31 and 70. So what you do is 70 drops. 70 drops. So once I hit OK, that becomes calibrated. The coordinates on that old high are accurate. Y'all see that? Hope y'all following. If you're not catching it right now, you can always go back and watch. So now that I got the high and I know where the liquidity is above the market, we're not done yet. I treat wicks. This is also a PD array, a more advanced PD array. You see this wick right here? It's like ghost zones inside of this wick. Retail doesn't know this, but the price action is algorithmic, and it will refer to levels inside of these large wicks that the average retail investor won't know about. It's hidden from the public. There are levels inside of this wick that are hidden from retail. And price will refer to these levels inside of this wick and reject off of them or use them as targets. So what I'm gonna do is I'm gonna take a Fibonacci, and the Fibonacci tool is not special. And most people on YouTube and in the crypto community, whatever, they don't know how to properly use Fibonacci's. It's nothing magical about no Fibonacci. It's just a tool of measurement. And what I'm gonna do is I'm gonna take the opening price of the candle right here. So the opening, if you don't know, look up at the top up here. Y'all see it up here? It gives you an open, high, low, close price. And if you don't know candlesticks, all candlesticks have an open, high, low, close. Bullish candles start at the bottom. They open at the bottom. For example, this candle right here. It opened right here. Bullish candles open, they trade low, and then they go high. They create a high, and then they find a close. And then bearish candles, they will open at the top. They will trade high, then they will trade low, and then they close. That's basic TA 101, if you didn't know that. So I'm sure I helped somebody out. Y'all hit that like button. Y'all hit that subscribe button if you're brand new to the channel. Get them likes up. So what I'm about to do is I'm treating this wick as a premium array. It's a premium array. I treat wicks like a gap. So what I'm gonna do is I'm gonna measure the opening price all the way up to the high. And what I'm gonna do is I'm gonna calibrate this trend. I'm gonna also calibrate this Fibonacci to this wick. And I'm gonna go to my settings, and I'm gonna show you my Fibonacci settings. So I'm not gonna talk about them all right now, but what I'm about to do is y'all can screenshot it, y'all can take notes, whatever y'all do. I'm about to show you my Fibonacci settings. I'm gonna pause it right quick. Y'all look, y'all take a glance. I'll start with the 0 to 1, the 25.75 level. You got -1, -0.5. I use all these, but how can I'm trying to figure out how I can explain it to you if you're new. So for example, the Fibonacci is like it's a measurement tool, and you can use it, you can apply it to project, you can apply it to project targets in the market. So for example, it starts down here at a 1. It goes to a 75%, a 50%, a 25%, a 0. And then everything outside of the 0, it starts projecting price higher. So I have to show y'all that on another day, how to project price. But right now, what I'm using it for is to measure the half of this wick. I want to divide it in half. I want to divide this wick in half right here. I'm gonna get the coordinates to calibrate it. I want to get the high. The high is 331.70. The opening price is 197.07. Now that Fibonacci is calibrated. Y'all see that? It's calibrated because look where price action currently is. It's just pausing. It's just sitting inside of this wick. It just paused. It didn't just stop for nothing. It's stopping inside of this wick over here. And what I'm about to do is I'm about to highlight the midway point. I'm gonna highlight the midway point. So I'm gonna take a trend line and I'm gonna draw it out right here. Y'all see this? I'm gonna draw it out. And I'm pretty much gonna line it up with the 0.5 level, which is the 50% level, which is the midway point. And then what I'm gonna do is I'm gonna calibrate it because I already calibrated from the open to the high. So these levels are accurate. Like I'm talking like precision. They're not off, they're calibrated. So what I'm gonna do is I'm gonna take this number at the 50% level, $62.64 and 39 drops. And I'm gonna calibrate it. Right there. So this trend line right now is calibrated directly to the midway point of that this wick over here. I'm gonna change this to a black. Because it's the monthly. What I do when I'm on the higher time frames, I like to have my PD arrays a little thicker, like the lines, like the trend lines. So what I'm gonna do is I'm gonna put that to a 3x, and then when I drop down the lower time frames, I like to have my trend line smaller. So when I'm on lower time frames, I can identify what's the higher time frame PD array. So y'all see that? As I draw this trend line out over here in price, you can see exactly where price has been trading. It traded above it, and now it rejected this level. Y'all see that? Can't make this up. That's algorithmic price action. I like to make it dashed or dotted. I got to recalibrate it because I didn't calibrate it right. 6439. I hope y'all paying attention. Y'all let me know. Give me some feedback. Are y'all learning? What's going on? Y'all give me some feedback. This is an XRP masterclass. And guess what? This works in all asset classes. I do this for every market. So this works in all asset classes. No, just pay attention. I'm not saying there's a 50% chance that price will drop. You got to pay attention, brother. I'm showing you where to find the hidden levels in the market that price will reach for and go to, because price is algorithmic. And if this is your first time, you're not going to get this the first time. This might be a lot for y'all. There y'all go. For y'all that's learning, you're not going to get it the first time. But when you hit that replay and you remember everything I'm saying is in detail. So when I say I measure my wicks like I do gaps, and I'm outlining how to measure it, and I give you my settings, pay close attention, because how I'm teaching it requires detail and attention. So I'm gonna leave that right there for now. So what I'm gonna do is I'm gonna remove. I'm also paying attention to the 25% level and this level. I'm not gonna draw it out right now. I'm just gonna draw halfway of that wick, and I'm gonna remove my Fibonacci tool. So boom, y'all see that? This is a PD array. I use wicks and price as PD arrays. A premium or discount array. If you're not familiar, a premium discount array. Above the market was a PD array, which was the midway point, the halfway point of this wick. You can see where price been all week, all month, really. All month it's been trading right here at this level without retail not even being aware of it. We opened up the month, the first day of the month, we shot up, we made this high, and then we've been holding right here in price, if y'all haven't noticed. And we're waiting to expand higher. They're holding price right now to get up to this high, which is where? The liquidity above the market. They're just holding price because it's algorithmic. I'm reading the comments right quick. Hold on. You said I'm getting it. It's the exact precision. So you basically, for the lower time frames where a little movement means a lot. Yes, on lower time frames, the smaller movement is a whole lot because there's a lot of capital. Okay, for example, inside of this monthly candle, if you just can envision that there's billions of dollars being moved inside of this candle right here on the monthly time frame. There's millions and billions of dollars being pushed inside of this candle right here. Before that, when we was in this consolidation 18 months ago, there was little volume. You see how small the candles are? There was not much volume in the market. But when you start seeing large expansion candles like this, they're pushing liquidity into the market. It's that simple. You can see it in the bodies of the candle. I don't need to look at any type of market cap, or I don't need to look at none of that. I can look at these candlesticks and tell you how they're injecting liquidity into the market by the bodies of the candles. Inside of the bodies are where the volume is. I don't need no indicators. Inside the bodies of the candles is where the volume is. And if you notice, I'm starting you from a high. We have not left the monthly time frame yet. We haven't left it. So once you identify, you want to get real detail. So once you identify your PD arrays, your premium and discount arrays in the market, come over here to the right of your screen. You want to save this stuff because it'll suck. You'll get lost real quick trying to find this stuff. So what you do is you come over here, you see these trend lines, you come over here to your what is this called? One second. Okay, it's called your object tree. Your object tree. And what you want to do is you want to put these in folders. So I'll take this trend line right here, and I will identify it as open float. And I'll talk more about that shortly. It's called an open float. Open float is pretty much them building liquidity above and below the market. That's what an open float is. And then, okay, this one right here, this trend line that's found on the midway point of that wick, I'm going to identify it as monthly wick. And there's further details that I can go into. So, like, for example, the midway point of this wick right here is called consequent encroachment. That's more advanced. I'm not even going to get into that. So what I'm going to do is I'm going to identify it as monthly wick PD array. I'm trying to keep it not so advanced. I'm trying to give y'all a basic framework. Remember, you can go back and watch this live stream. Okay, y'all talking about something else in the comments. Y'all should be paying attention. Y'all should be paying attention. I don't know what y'all talking about. Because on-demand liquidity ain't got nothing to do with this right here. I'm trying to tell y'all. If you want to learn technical analysis at a high advanced level, that ain't got nothing to do with this. So, we arrived at the premium discount arrays. We defined what the market structure is on the monthly. And also you want to come to a bias. So what is bias? You want to pretty much define directional bias. Your bias is, since we're on a monthly time frame, you want to pretty much forecast where is price going to go to next. So your bias, since we're already up here trading, where do you see this monthly close, and where do you see the upcoming months? You can pretty much, once you get good at this, you can start forecasting price before it happens. So you can see we've been in consolidation. We expanded last month in November. Currently in December, we're expanding. So going into January, February, where is your bias? If we close, we got 13 days left in this calendar right here. Once we close, let's say we close above the midway point. That would be very bullish if we get a monthly close above this midway point of this wick over here, going up into closer to this liquidity. So once you draw out your PD arrays, you define market structure in the past 18 months. Now you want to come to a bias. Where is price most likely to go? And y'all tell me in the comments where y'all think prices most likely want to go. What is going to reach for? And if y'all new to the channel, y'all hit that subscribe button. I appreciate y'all time. Somebody said to the moon, y'all funny. There y'all go. Y'all answering. For y'all don't understand, y'all new, look at the comments. They're saying to the liquidity. Price always, the number one thing price is going to do is going to seek the liquidity. Why? Because there's orders. Imagine people accumulating billions of dollars, Let's say all the way back in 2017. Imagine the people that then dropped hundreds of thousands of dollars into XRP, and they might want to shave some off right here at this liquidity pool up here. Well, there's millions of dollars that's been made. But I'm going to get in also to like, okay, let's also define what XRP is. What asset class is this? That's what we need to define. We're not just in like this isn't just a trader's market, even though they will come with traders products. So I'm a trader. I'm a trader first. I feel like there's so much opportunity to be made to cash flow in trading. But I also realize, okay, this is a digital commodity. This is software. And I get more excited about this every day because this is a new asset class and it's just different. So I also know that I'm investing in the asset XRP. I'm a trader first, but also I can also long-term invest. So when I'm on this monthly time frame, I'm treating this as, because I've been accumulating at such a discount, I'm becoming a long-term position trader. So that a position trader is also a long-term investor. So if you're an investor long-term and you're a hodler, quote unquote, you're also a position trader. You're still technically a trader if you're holding something for a long time. You're just doing it for a long period of time. Also, these are digital assets. Y'all also see what's going on with the RLUSD that's bringing liquidity to the network and all that. I can get into the technical side of it, of the technology, but I'm a trader first. And I also combine the two and I realize, okay, this isn't a trader's market, even though there's traders in this market. There's a lot of liquidity in this market that traders are trading with. But right now I am an investor or a long-term position trader in the commodity or the digital asset XRP because it's digital software. It's not a trader's market. Most markets that I day trade in, they're paper markets. They're derivative markets. They're paper based. I'm not really holding like a S&P, a real S&P contract. I'm not really holding gold. You can go in those markets and trade on paper and earn a great yield because you're trading with debt. But with these markets, they're not paper markets. This is not a paper market. So you got to rethink about, okay, your strategy, because I'm a trader first. I trade mostly the futures markets. I trade the Forex markets. Those markets are paper derivative markets. And you can amass millions in those markets. Just trading paper contracts. But this is completely different than paper markets. But when they come with futures products for XRP in a regulated environment, that's when I will hold the digital asset, cold storage, hidden in the desert somewhere in the jungle. I will hold the digital asset XRP, but I also will take advantage of the volatility short term as a day trader in this market because it trades just like any other market. It's algorithmic. It moves just like a regular paper market. And there's a massive opportunity for people who want to trade these markets as day traders, but we have to wait for regulations by the CFTC. So that's why I don't day trade crypto. But when I'm dropping down the lower time frames, it all applies to help me get in sync with order flow to call the market correctly. But I'm gonna get to that. Right now we're still on the monthly time frame. Sneaky Pete, you don't think it's a commodity? What you mean? Y'all hit that like button, hit that subscribe button. This is a masterclass in technical analysis. This is something that you can go replay, take notes. Okay. So, just for fun, but I don't think it's going to come back down here. You see this right here? I want y'all to tell me what this large candle is. What is this large candle right here? Look to the left, look to the right. What is that right there? I'm trying to see who knows what I'm talking about. What kind of PD array is that? I want to know what kind of array that is and what is it? Is it a P array or a D array? Okay, what type of fair value gap? Is it a premium gap or is it a discount gap? Is it above the market or below the market? Y'all tell me. There you go. So it's a discount PD array. It's a discount PD array. There y'all go. So I just wanted y'all to note that, but guess what? I'm not going to draw it out because I don't think it's relevant because we move so far away from it. If price wants to come down, which it can, so I'm gonna go ahead and highlight it just for y'all purposes, but I don't have it currently in my charts. Y'all see that right there? That's a large, this is one of those you don't want to see come back to. But with the narrative right now in the market, with the narrative with RLUSD going live and Ripple moving forward and a new regime coming into the US markets, there's no need for them to come back down here. I see it going back up to I see it going to the all-time high if they want to retrace it down to these levels. So I'm going to remove this because once I drop down to the weekly, you're going to see the weekly gaps that are inside of this monthly candle right here. So I'm going to remove that, but I'm taking note of it. I'm fully aware of this large gap in price. But order flow and market structure is bullish. We're trending now. We broke this consolidation. Now we're trending. So we're in a trending profile. So now watch. Now I'm about to drop down to a weekly. So we got our monthly levels outlined. Got our monthly levels. I'm going to identify this wick, the midway point of this wick. It is a monthly wick CE. CE stands for consequent encroachment. It's like it's a key level, kind of like the midway point of the fair value gap. It's a key level, just like the fair value gap when I drew the fair value gap. So when I draw the fair value gap right here, I'm going to draw it out one more time. Y'all see the midway point of that fair value gap? Price will react off of that midway point real specifically with precision. But I'm gonna remove that. That's how the wicks operate too. It will go up there. Y'all can see it go up there, trade through it a little bit, reject it. So I'm gonna highlight that. I'm gonna keep that right there. Now what we're about to do is we're about to drop down to lower time frames, which is the weekly. The monthly is a long-term position trader's chart. So what we're gonna do is we're gonna go top down to the weekly. So now let's go down to the weekly. Now we're down to the weekly. So do y'all see how price is a matrix? Y'all see how price is a matrix and we're transposing to lower time frames. So everything on the monthly up above the market, once we drop down below to a lower time frame, now you can see how it transposes on lower time frames. The higher time frame PD arrays are more significant than the lower time frames. I'm gonna say that. Price is always gonna want to reach for the higher time frame. No matter what time frame you're on. If you're on a 5-minute, price is gonna want to reach for the 15-minute PD arrays. If you're on a 15-minute, price is gonna want to reach for the 1-hour PD arrays. If you're on a 1 hour, price is gonna want to reach for the 4-hour PD arrays. If you're on a 4-hour, price is gonna want to reach for the daily and the weekly PD arrays. So the higher time frame is the most significant time frame. So on the weekly time frame, this is still a long-term position trader's chart. And let me drop back out to the monthly. I'm going to be going. We're doing a top-down analysis. I'm reading the comments. 1 second. Okay. What you mean, Scott? That's gold. Explain yourself. Was it what I just dropped to you gold or what? What I'm about to do is I'm going to highlight the last 18 months. I want to say it was right there. That candle right there. I'm going to give it a white color. So inside of this window in time on the monthly, this was the last 18 months. So what I'm about to do is I'm going to drop down to the weekly to give y'all that perspective on what that looks like. Y'all see that? This price action inside of that weekly window that's in white, this was 18 months of price action. This is a consolidation profile. Market structure is consolidating. And then boom, now we're trending in an expansion. So I wanted to highlight this to show y'all what it looks like. The pad, once you drop down from a monthly, I'm gonna go back out to the monthly. 18 months worth of price action, including the current candles. And then I'm gonna drop down to the weekly, and you can see how price is fractal. So if y'all don't know, price is fractal, and it's like a matrix. So every time you drop down to low time frames, all price action is still relevant as you drop down to lower time frames. It's like a matrix in time. So pretty much on the weekly, we're gonna do the same thing. We're gonna look for the PD arrays above and below the market, and they're gonna be weekly PD arrays. So I'm gonna remove that right quick. So now, once we drop down to the lower time frames and you zoom out, well, we know you can't see, if you zoom all the way out, you can't see everything from, well, yes, you kind of can, but once we drop down to the weekly, you're more narrowed in, focusing on the past several weeks of price action. This is Casey. This is a Trading View. Trading View. It's a website. It's a web platform. Trading View. Y'all hit that like button, subscribe if you're new to the channel. I appreciate it. So when you drop down to the weekly, you also want to determine what's the market sentiment. What's market sentiment right now? Y'all know Ripple crypto is doing positive right now, so that's why y'all seeing this trend right now. You want to identify the market profile. So the market profile, we're in the trending profile. We're not consolidating. We broke out of consolidation. We started trending. And then what? You see this drop in price? That's a retracement. So the market goes from consolidation, expansion, retracement, reversal. That is all the market price action does as far as market structure. Consolidation. The market always starts in consolidation. Y'all see it? And then it goes to an expansion, which is trending either bullish or bearish. And then retracement. This is what you got right here. This down close candle. Retracement. All retracement does is offering you an opportunity to either enter a buy or a sell. In this case, we're entering a buy. I'm gonna go ahead and draw it out. I'm gonna draw out the weekly fair value gap. Y'all see this candle right here? Look to the left, look to the right. This is a weekly fair value gap. I'm gonna draw it out. Boom, right there. That's a weekly fair value gap. What makes this a fair value gap? So what I want to do first, I'm gonna calibrate it. So what you do is you go to these settings, go to the settings, go to coordinates. You want to get the low. So here's what, this is the gap. The large candle is the gap in price. Look to the right. You want to get the low of this candle right here, which is the wick low. That wick low is $2.17 and 85 drops. So what you want to do is you want to come over here, calibrate it. And then you want to look to the left of this gap and get the wick high right here. That high is $1.63. And how I'm getting the prices, look up here on the left side of the screen, the top of the screen. You got to open, high, low, close. And what I'm doing is I'm getting the high coordinates of this candle right here, the wick high that makes the bottom of this fair value gap. And that price is $1.63, 12 drops. Like that. And then you can always color code. So I'm using colors to identify what time frame I'm on. That's all I'm doing. So when I'm using different colors as I drop down to lower time frames, that just helps me identify what time frame that is. And it can be preference, whatever you want to do. It's all preference. It's nothing, it's nothing special about the colors. I'm gonna put a text. I'm gonna identify. I'm gonna highlight weekly fair value gap. And then if you want more details, since we're here already, I'm giving you the master class. If you want more details, what makes this a fair value gap? And this is where you take your notes. Why do fair value gaps form in the market? They're all over the market. Even got ones below the market. You got one down here. But since we moved away from it, I'm not even going to reference it. I want to use the one that's nearest the price on the weekly time frame. This is a fair value gap. It's a specific type of fair value gap. There's two types of it's really three types of fair value gaps. I'm gonna give you the two, and then I'm gonna talk about the third one. If we're in a bullish market and the gap and the market gaps open, that is referred to as a BISI, a BISI. What is a BISI? A BISI is a buy side imbalance, meaning it was imbalance going up. It was one directional, so it created an imbalance in price. It's a BISI, buy side imbalance, sell side inefficiency. It was inefficient with selling. That's algorithmic. Doesn't that sound like a coded algorithm? So when I say fair value gap, that's just to keep it like real short and simple. But I don't refer to them as fair value gaps. I just do that to help people understand, make it simple for them. But this is a BISI, a buy side imbalance, sell side inefficiency. It was imbalance going one directional, which is higher, and they didn't offer any selling in this price action. So what does the algorithm want to do? It wants to come drop down and make this efficient. Well, in this process of them dropping it down to make it efficient, that's your buying opportunity right there. And if y'all notice, price hasn't even came back down here since last week. Y'all hit one if y'all paying attention. Y'all paying attention. Y'all taking notes. If y'all not taking notes, this is one you can go back and watch the replay on. So this is a BISI. So in a bearish market, let me see if I can go find a SIBI. That's a BISI, BISI. And SIBIs are sell side imbalances, buy side inefficiency. So it's pretty much opposite of what a SIBI is or a BISI. So for example, y'all see this gap right here? This is a large one. I like to refer to the large ones in price. Y'all see this drop right here? This is a SIBI. It's opposite of a BISI. It's a sell side imbalance. What is it inefficient in? Buy side. Buy side selling. They didn't offer any buying when they drop price down. So what does the algorithm do? It refers back to it. So as I draw that out in time, I reference the high, the wick low up here, and the wick high. And do you see how the algorithm reprices back to it? Look how precision, look at the precision in that. It goes up, look at the top of it. Why doesn't it just break outside of it and continue higher? It draws up into it, trades inside of it for several weeks, and then what it does? What does it do? It rolls over. Y'all see that? So that's a SIBI. If we're in a sell program, if the market is trending lower, which is a sell program, we're looking for SIBIs in the market. So that's more advanced when it comes to fair value gaps. I hope y'all took notes. You said your mind blown? Hey, I said this is going to be a masterclass. And hey, you can go back and watch it. I'm showing you how the algorithm is referring back to old prices in the market. And I pretty much be knowing ahead of time. You're all good. You're all good. Y'all hit that like button, hit that subscribe button if you're new to the channel. So y'all see the BISI below the market, buy side imbalance, sell side inefficiency. So right now I'm just going to refer to it as a fair value gap, but I gave you those details. Also, remember, even on the weekly, we're looking for premium discount array. So this is a discount. This isn't just a fair value gap. It's a discount fair value gap. Anything above it, which there's nothing above it right now, is a premium. I'm also looking at the wicks. So remember what I did on the monthly where I measured this midway point on that wick? Okay, guess what I'm about to do right here? I'm looking at this wick and price. Also looking at this fair value gap. So I'm gonna take my Fibonacci. I'm going to measure the closing price all the way down to the low. Y'all see that? Price is pretty much, it didn't really offer too much. So as I drop down the lower time frames, it will be, I will be able to see more details. So this is a weekly time frame as well. Excuse me, 1 second. This is a weekly time frame as well. So if you look, you gotta put it in perspective. You gotta put the time frames in perspective. So let me drop back out to the monthly. Okay, on the monthly time frame, we got 13 days left and 23 hours to complete this candle right here. we know that we got 4 weeks in a month. So as I drop down to the weekly, if we look back 2 weeks ago on this calendar right here, this started the month of December. And then we go into week 2, week 3, week 4, if we go to the right, week 5. So there's 5 weeks this week because December started in the middle of the week at the end of November. So I think it was like a Wednesday, Thursday, whatever. We started December in the middle of the week. So it's really 5 weeks, but it's really 4. We all know there's 4 weeks in a month. We got inside of this weekly candle, we have 4 days left. So as you're looking at a weekly time frame, this chart is moving very slow. It's still a long-term time frame. You could see last week when price dropped down and everybody panicked and they had the 60-minute interview with Brad Garlinghouse, and then they turned around and announced the RLUSD will be it was approved. All of this, I already knew when this candle formed right here. I already knew last week they was going to drop price down into this weekly fair value gap. Y'all see that? I already knew last week when this candle formed. 2 weeks ago, I knew. When this candle formed, we dropped down. Guess where it went? Look how precision and accurate that was. It went directly to the midway point and rejected off of it. Y'all see that? This created a low of $1.90. $1.90. The midway point of this this fair value gap is what? $1.90. Y'all see that? Precision. So if you wanted to be a buyer, that was your opportunity to buy XRP at $1.90. You're not going to get it back below the market like we once did. You're not going to get it because look, we're in a trending profile. Y'all see this? We're not consolidating no more. We're not reversing. We're trending. They offer retracement to a discount, and you should have accumulated inside of this gap. Also with fair value gaps, guess what you can do? You can lay your Fibonacci from the high down to the low, and I'm doing it just like the wicks. And guess what you can do? You can measure the quadrants. We got the midway point. Y'all see how the 50% level lays directly over the midway point of that fair value gap? Y'all see that? And then the 75% level and the 25% level are the quadrants. We got the upper quadrant. We got the lower quadrant. Below the 50% level is discount, a deep discount. Above it is a premium discount. They didn't want to drop it all the way down to a deeper discount. They just wanted to offer a quick discount up to the midway point and leave it. They wasn't being generous and friendly. So when you see fair value gaps that retrace a little bit deeper and we go below the 50% level, that will be them offering a deeper discount in the market. And let's say I wanted to color code this, which I don't do this, but let's say you wanted to, at the top, watch when I lay another fair value gap from the high down to the midway point. And then I add, like, let's say a red. Y'all see that? That's a premium. And then I'll take one from the midway point down to the bottom. Midway point down to the bottom. Y'all see that? Now look what that gap just did. It drops down. Here goes the midway point right here. Above the midway point, that's a premium discount. It's not just a premium in the market, it's a premium discount. You got this overall fair value gap. It's a discounted fair value gap. But then you can start measuring the fair value gap from a premium fair value gap all the way down to a discount fair value gap. Hope y'all paying attention. Y'all see this? If you're missing anything, just go back and watch the replay. And you should be applying this to some type of platform. I'm using TradingView. So let's say you wanted to hypothetically place limit orders. Let's say, okay, you see this, you identify this gap in price. I'm telling you, you're already ahead of the news. You're ahead of social media. If you're identifying this in real time, you're ahead of everything. You can see it in the market because you're in sync with the algorithm. So that's how you're able to see it before the news and everybody else sees it. So let's say you wanted to set limit orders and choose your targets. Let me remove some of this stuff right quick. I was just trying to give y'all details on a premium discount. inside of a fair value gap. So let's say you want to set limit orders because you identify this gap in price. Well, guess what? If you want to guarantee fill, you set a limit order directly at the top of this fair value gap. That'll be a price of 217. You seen the price drop down there. You said that will be your first limit order. And you set another one at the 75% level. Guess what it did? It dropped down. It would have tagged your limit order. And this is not you rushing to the market trying to place orders inside of an exchange. You already got them set. And you're just chilling, and the price goes down there and you're at work or you're chilling, whatever you're doing in your life, your orders will be filled. And then look at the midway point. You can set a limit order there. So you could essentially enter 3 times, 1, 2, 3. And if they wanted to offer a deeper discount, you can set one at the 25% level. Y'all see that? And then all the way at the bottom, you could have set a limit order. And if it didn't fill, well, heck, no problem. I got filled on 1, 2, 3 entries. Just like that. And you can see price leave it and reject it. And we haven't been back down there since. Y'all hit 1. If y'all paying attention, y'all understand. I'm teaching on a deeper level. I'm trying to, I need to move forward. So what I'm doing is I'm taking from a top-down analysis, higher time frame down to a lower time frame. Pretty much what you did on the monthly. You want to drop down to the weekly and do the same thing. You hold until what? You get to premium arrays. This fair value gap is a discount array. And this is like trading, but we all know we want to hold. Let's say you missed out on XRP because we know XRP and these digital assets are a completely new and different asset class. You should not be trading in and out of these if you're holding the digital asset physically or on a cold wallet. But if you're trading, let's say a paper market, and I'm anticipating there's a lot of traders that trade XRP USDT. That is a paper market. That isn't actually holding the digital asset. There's millions and billions of dollars being traded on XRP in the pair USDT. People are taking risks trading those pairs. I don't do that. I'm waiting for regulation to come in so that I can trade a legit XRP contract from a regulated broker. But you see that this is a discount array. You will enter at a discount, and what we do, we exit at premiums, which will be above the market. But let's say you're holding the asset XRP and you missed all this and you're new to XRP. And most people jumped in the market and start talking about it and blowing up the algorithms on social media when it started doing this. By the time XRP started moving higher, here comes all the hype, all the people trying to get on the train. Y'all witnessed it recently because when the market was back here 18 months ago, there was nobody talking about it. It actually got real boring and real dry. Nobody was talking about it. This was a brutal time in the market. But guess what? Smart, intelligent investors with high IQs, they was accumulating at discount arrays. And let me drop back out to the monthly. Let me show you the discount array XRP was being held in for years. So let me zoom over here. Let's go all the way back to 2017. Y'all see this candle right here? Y'all see this? Y'all already know what that is. That's a discount array. But what kind of discount array? I'm waiting on y'all. What kind of discount array is this? It's a fair value gap, but instead of a SIBI, which is SIBI, it's a BISI. It's a BISI. You don't have to worry about that right now. Don't worry about the SIBI and BISI. Just identify this is a discounted fair value gap, or we're going to find one at the above the market, which would be a premium. This is a discounted fair value gap. At later times, I will give you the more advanced version of what the fair value gap is. I just threw that out there to show you that there's levels. It's levels to this. So I'm going to identify that gap right there. Y'all see that? That's a fair value gap, a discounted gap. And look how long price stayed inside of this discount gap. Y'all see that? Several years. And this is why I'm doing this chart over. I'm switching over from the old chart I was because it didn't have all this data back here. But look at this gap right here. Y'all see this? This is from 2017, May of 2017. That is a clear what? That is a clear fair value gap. I'm gonna identify that. This is on the monthly time frame, long-term chart. Let's identify that fair value gap. So pretty much, if y'all been listening to me, I've been saying, hey, price can keep trading back down to these gaps for several weeks, several months. This was back in 2017. This is on the monthly time frame. A fair value gap forms. Look how many times they dropped down into this fair value gap before what? Leaving it and exploding higher. Y'all see that? That's exactly what's going on right now. That is exactly what's going on right now on the weekly time frame. This same pattern in the market. So this is a weekly fair value gap. Monthly. Let me give it another color. That's a monthly. And this is a monthly. And guess what? They retrace. One, look at the midway point. You see they drop it down there. Look at the accuracy and the precision. They drop it down. If you wanted to be a buyer back in this time, the high would have been 21 cents. 2017, 21 cents. Then they drop it down to the midway point. That's 14 cents right there, XRP. You could have set limit orders, remember, at the top, at the midway point, at the upper quadrant. I'm eyeballing it. I'm not even drawing it out, but I'm eyeballing it. But for completeness sake, I'll draw it out for y'all. So let's say you missed this 14-cent level. You could have put limit orders at 17 cents. Imagine accumulating XRP at 17 cents. And then they held it down there for several months. 1, 2, 3, 4, 5, 6 months. They allowed people to accumulate XRP at that price. And then boom, expansion. So it went from a retracement into the fair value gap into an expansion. Most people missed that right there. But guess what? It's not over with. Let's draw it all the way. That's from 2017. Let's go out to 2020. They refer back to it in 2020. Y'all see that? Y'all see that? It traded below the market, dropped down back to what? The midway point. Y'all see that? 2020. Hit the midway point. What kind of array is this? It's a discount. What do? We buy in discounts. We sell at premiums. And the market is going to continue to do this pattern. It's going from discount to premium, premium to discount. I don't care what market you're in. It's going to always offer a premium. It's always going to offer a discount. And I'm outlining how to identify it at these fair value gaps. It's not just that it's a fair value gap. It's a discounted fair value gap. So they drop it back down in 2020 twice. They stayed down. I think that's when the lawsuit hit. And it was down here for a very long time. Dropped it down to 11 cents. Dropped it down to 17 cents. And then from there, 2020, that's when a lot of people started to come into XRP. And then they expanded price higher. They retrace. And then guess what? There's this one over here. This is the inversion fair value gap. So that's the third fair value gap that I was talking about. We got a BISI, a SIBI, and then there's something called an inversion fair value gap where we don't just trace to it and expand higher. That's traditional. That's a traditional fair value gap. Inversion fair value gaps, we can cut through them several times, going above them and below them. And you can see how they hold price inside of this one above right here. This is an inversion fair value gap where we trade below it. We trade above it, trade back down into it, consolidate inside of it, and they hold price for several years inside of this fair value gap. And then finally, boom, expansion candle higher. That's an inversion. Y'all paying attention? I hope y'all paying attention. So I give y'all 3 types of fair value gaps. A BISI, buy side imbalance, sell side inefficiency. A SIBI, sell side imbalance, buy side inefficiency. And an inversion gap, where we can trade to one and cut through it several times, using it as support and resistance. Eventually looking for what? Liquidity. Liquidity comes first. That's what the market is going to reach for. It's going to reach for liquidity at all times because that's where they leave their pending orders at in the market. So let's move on. I'm gonna remove this, but I had to show y'all that most people wasn't aware that when they was holding price, they wasn't just holding price down here. If you was able to identify this with, like me, I already knew. That's why I was patient. I never got impatient because I knew where they was holding price at in the market, and it was done algorithmically, and they held it for since 2022, really longer than that. But this pattern right here, this long consolidation, 2022 all the way to November 2024. That's how long they held it inside of this area in price. And they kept referring to it. The OGs got in down here. I don't know too many people that got XRP before 2017, but they're out there. And let's go look at the price action before 2017. You can go all the way back to 2013. I don't know too many people that got XRP in 2013. It was all about Bitcoin then. And then here about 2017, March of 2017, XRP started to wake up and show some type of volatility in life. I don't know too many people who was getting it then. I remember seeing it, but again, like lack of education, didn't know nothing about nothing. Didn't even know how to do TA. I was just throwing money at Ethereum, Bitcoin, Litecoin, Bitcoin Cash, Electroneum, all the OG cryptos. Didn't know nothing. Just like most of everybody are, most people are doing now. Throwing money at the market. It wasn't until 2020 during the pandemic where I had to sit down. I had time to sit down and I was older, a little bit older and a little bit more wiser. And I said, I want to learn a new skill set. And it so happened to be technical analysis. Learning TA. I found the book, how to make like $10,000 in a month. And it was talking about TA and it was up from there. But that book didn't teach me this type of how to read the markets like I do now. That book, it just introduced me to the financial markets and technical analysis. Nothing in the books. There's nothing in books that will show you how to read price action like this. There's no books showing you that the market is algorithmic. You're not going to find it. Y'all hit that like button if y'all new to the channel. Subscribe. So, okay, I'm getting off topic, but I just had to show y'all that right quick, that if you was aware of this in the market, this discount array, you could see visually how long they held price inside of this gap below the market. But if I take that off and you wasn't learning what I'm learning, you wouldn't know nothing about that. Look at that chart. You wouldn't know nothing about that. I'm seeing stuff that most people not seeing. I'm seeing stuff that most people not seeing. So, okay, let's drop back down to the weekly. Pretty much when you drop from the monthly down to the weekly, you're doing the same exact thing. You're doing the same exact thing from the monthly down to the weekly. You're identifying market structure. You're identifying the direction, the future direction in price. So you're identifying the discount arrays. You're identifying the premium arrays. Right now, I pretty much only taught you fair value gaps and liquidity pools. Number one priority, liquidity pools. When we're trending like this, when price breaks out and starts trending, you want to pretty much jump to where's the gaps. They're going to leave behind gaps. I'm measuring the wicks. So I pretty much gave y'all 3 PD arrays, premium discount arrays. I got over a dozen of them, but I only gave you 3 of them so far. So look at the wicks in price. You want to measure wicks by using your Fibonacci. One PD array is the fair value gap. This dotted trend line right here, that's the wick on the monthly. That's the midway point. And then up above the market, liquidity. So the next thing we're going to do is we're going to drop down to a daily but when I drop down to the daily, this is what I'm going to do. Y'all pay close attention. I'm going to take a vertical trend line. See this vertical trend line right here? I'm going to drop it on the previous month's candle. I'm going to take a vertical trend line and drop it on the previous month's candle. So we're on a monthly time frame. I'm going to take a trend line. I'm going to drop it on the previous month. And at the end of every month, what you're going to do is you're going to take this trend line and you're going to draw it over every month. Y'all see that? Every month. So when this month closes, the new month candle opens, you're going to just drag this trend line over, so on and so forth. But how you start it is you're going to drop it on the previous month, like right there. Now I'm going to drop down to the daily time frame. Now, what am I doing? What am I trying to outline? Now we're dropping to lower time frames. We're getting more fractal, more refined. This is what I'm about to call a look back and a cash forward. Before I do that, I need to label my PD arrays in my object tree. So this is a weekly fair value gap. I have it in the folder. I can refer to it at a later time. This new information that I'm about to present to you is called the look back and the projection forward, or the forecast forward. So y'all can see how this information is getting way more detailed. This is naked price action. This is naked TA. Y'all hit that like button. Y'all got any questions? Are y'all learning? You said my off topic is on point? Yeah, because it's all relative. When I get off topic, I'm not pretty much, it goes, what I'm presenting to you, it gets deeper than what I'm showing to you. It's way more advanced, and I'm trying my best to present it to you in a basic way. That's why when I get off topic, I'm actually showing you more stuff. So y'all see this vertical line right here. I dropped this on the monthly time frame. Y'all see that? What I'm about to do is I'm about to take a ruler. And what I want to do with this ruler, I want to drop it directly on that vertical trend line. And what I'm going to do is I'm going to look back 60 days. So this ruler, it measures the days right there. So you see right here, it says 60 bars, 60 days. So what I'm doing is everything to the left of this trend line, I'm looking back in time. And like I said, you do this every month. So from November 1st down here to September 2nd, I'm going to take a trend line. I'm going to drop it right directly on that vertical trend line. I'm going to go back all the way to September 2nd. Okay, y'all got that? Y'all got that? 1 second. You want to add that trend line into your folder. So what you're doing is you're going to take a trend line. This represents 60 days ago. 60 days ago. And then, okay, now I want to clone it. You're going to clone this trend line. So you're going to go to settings. You want to clone it. And then I want to look back 40 days. What was 40 days to the left of this vertical trend line? So from November 1st, 40 days ago, was September 22nd. That was 40 days ago. Remember, we're on the daily time frame. And then I'm going to clone it one more time. And I want to look back 20 days ago. 20 days ago was October 12th. Y'all see that? So everything to the left of everything to the left of this vertical trend line, I'm looking back 60 trading days, 40 trading days, and 20 trading days. And then what I'm going to do is, after I look back 60, 40, and 20 trading days, I'm going to forecast forward 20, 40, 60 trading days. And what I'm doing is I'm cloning it so I don't have to like redraw it out. And that still measures 20 trading days right there. So I don't have to like measure all that, pull out the measurement stick and all that. and this is naked price action. What I'm doing is this pretty much is referring to the data point. It's data is pretty much collecting data in the market. I'm pretty much looking back in time, and I'm projecting forward. So as I zoom up, this is a daily time frame. Why do I use this right here? So everything to the right is price at essentially. Okay, follow me. Essentially, if I take my ruler, I'm gonna take my ruler and I'm gonna come out all the way to this 60 trading days back on September 2nd, and I'm gonna measure all the way up to December 31st, which is the last day of the month, last day of the year. Y'all see this right here? That's 120 trading days. I'm essentially looking at a window in time of 120 trading days, which is what? 4 months? This window in time right here is 4 months of price action on the daily time frame. So when you drop down from a monthly, weekly to the daily time frame is a long-term chart, but it's also a hybrid of a short-term chart. So you can be a short-term trader or a long-term trader on the daily time frame. Let me read the comments. The Y40, because again, I just highlighted how you come to 40, 60 trading days. And then I'm gonna get into more specifics on how to use the days. So I'm gonna drag this up a little bit. I'm gonna show you why I'm doing this. Right now, XRP is trending, so it's kind of like, it's better when the market is ranging, meaning it's going back and forth. But when we're trending like this after a tight consolidation, a lot of stuff, when I'm looking back to the left, is irrelevant. This is how I know. This is why I say when I'm on the weekly and the monthly that we're not going to come back down here, because all this is irrelevant now. We're trending now. So if we look back, let's just look back in price. And I'm going to highlight this right here. The past 20 trading days. What are you doing on the past 20 trading days? I'm looking for where the liquidity is. Where's the liquidity in the last 20 trading days when I'm looking back in time? One second. I'm gonna hide that middle line right there. So, okay. Let me make it a different color. Let's say green right there. So what I'm doing when I'm looking back the past 20 trading days, I'm looking for the liquidity in the market. So how do you find the liquidity in the market? And this is more long-term, higher time frame liquidity because we're on the daily. So what we're doing is when we look back the past 20 trading days, we want to look for the lowest low and the highest high. And like I said, it's better when the market is ranging, not trending like this. Once we break out like that, we're not going to come back and refer to this liquidity down here because we moved dramatically away. So what you're doing is you want to find the highest high and the lowest low. Here's the lowest low right there. And again, you want to do this for every month. That's a low. Below that low is what? Sell side liquidity in the market. That's where pending orders, they left behind orders in the market that they most likely don't have to refer back to. And then you want to find the highest high right here. Y'all see this high in the last 20 trading days? What's above that? Buy side liquidity. Right there. That liquidity was taken. They liquidated that liquidity and then the market broke out. So again, here's this middle trend line right here. That's the middle. And we're looking back in price. So once we crossed over to the right, y'all see where price went, right? It traded up. What did it do? It took out the liquidity right there. Look at the reaction in the candle right there. You see how it wicks up? Trigger those orders, and then it sucks those orders back inside the range. It consolidates, and then it takes off. That's why most time when we take out liquidity above the market, it will reverse and retrace back down. But they was ready to move the market and break out a consolidation. This move right here was the breakout after that long-term consolidation for all those years. As I zoom out, that was the breakout. That's how you know we started a breakout right there. Once we took out that high, the market started to break out. So once we take out liquidity, guess what? It's no longer relevant. So after you look for the highest high and the lowest low in the market, the past 20 trading days, now you want to go out the past 4-day trading days. You want to look back the past 40 trading days. And you want to do the same thing. What's the highest high and the lowest low in the past 40 trading days? Well, we already found the low in the last 20 trading days, and it didn't create any lower lows. So we're going to still use that low. That's the low of the past 40 trading days. And what's the high? Do y'all see how the market is doing certain things? That's why I say 20, 40 trading days, 20, 40, 60, because you can expect every 20 trading days, the market is going to create a high and a low. That's algorithmic. That's not random. That's algorithmic. Every 20 trading days, the market is going to create a high and a low. So in the last 20 trading days, there's that high, there's that low. Y'all see that? Identify. We took out the liquidity. Now there's the highest high and the lowest low in the past 40 trading days. Y'all see that? That's the liquidity above the market. Where did price go? It went directly for that liquidity. Y'all see it? Took it out. Once you do that, you want to identify the highest high and the lowest low in the past 60 trading days. Well, that's the range right there. Highest high, lowest low, past 20 trading days, past 60 trading days, and then you see where did the market go? It went directly for that high in the past 60 trading days. And then once it broke out, well, it started going for old highs that you would have, like I said, every month, you want to repeat this process at the beginning of the month. So because the market was in a tight consolidation, these highs were left in the same process that I'm showing you. So previous months, I did the same process, highest high, lowest low, past 20, 60 trading days, 20, 40, 60 trading days. And then you would have had this high in the market after taking out previous high right here. Where did price go? Directly for the liquidity. And if we draw this trend line all the way over to the left, there go equal highs right there. Liquidity. And then let's say we continue over to the left of the screen. Look at this old high up here. Y'all see that? Where did it go? Buy side liquidity. Look where this candle went right here. Look how precise that is. It went directly up and failed to touch it right there. It failed right there, and then it drew price right back in. So it failed. Y'all probably remember this. This week, this day or this week, it went up to about 92 cents, and people was like being real anxious. I remember. And then the following day, it broke out. But it didn't just break out for no reason. Where is it going? It's taking out liquidity above the market. And if you keep going all the way out, and at this point, you want to drop out to the weekly. You start looking at the weekly, you can see it clear. And you start seeing the liquidity above the market that they have been stacking in the market. So the whole point of me showing you where's the highest high and the lowest low in the past 20, 40, 60 trading days is to identify the liquidity, because the market makers are going to want to refer to it at a later date. So what they're doing is they're stacking orders in the market if you repeat this process. And then guess where it goes? It takes out old liquidity, eventually takes out this high up here, old liquidity. And that's how I'm able to predetermine where the market is going. 46 people in the building. Y'all hit that like button. I appreciate y'all joining. This is a master class on technical analysis for specifically XRP. This applies to all asset classes too. So if you want to do this in stocks, Forex, crypto, this goes into all asset classes. If you missed or you just joined it, you can go back and watch the replay because it's a master class. It's something that you can repeat. It's for free. It's for free. So you should be able to learn a lot. So after you find the, after you look back 20, 40, 60 trading days, so guess what? We want to start what? Forecasting. We want to start forecasting 20, 40, 60 trading days. Y'all see that? And the same process repeats. Well, in this case, we're not consolidating in a consolidation profile. Now we're in a trending profile. So if I start looking forward, forecasting in the future 20 trading days, well, we got the old high that they left, the old low that they left behind in the market in the past 60 trading days. Now you want to find the high. Where's the high after 20 trading days? Right here. So as we go on forward, because this is like, I'm redoing my chart. So a lot of this data done already happened. As we go forward in the market, you're going to see that we're taking out those highs. So if we refer to the lowest low and the highest high, here's the lowest low, which is an equal low to this low right here. So there's a large pool of liquidity that they left behind in the market. They don't have to come back and refer to it, but they can, but they're not. The high in the forecasting in the future 20 trading days is right here. Y'all see that? So if I draw this window in the future 20 trading days right here, you want to identify the low and the high. I'm gonna drag this up, and you can see there goes the high right there that formed. I would have that outline before all this price action happened. Y'all see that? We go up here, we take out some liquidity all the way to the left of the market, and then we retrace, we drop down, and then we consolidate for a few days, and then boom, what we do, we start expanding higher, and we break that liquidity up there. It's seeking liquidity at all times. Price is seeking liquidity at all times. And then what you do, you want to next go out the future 40 days and 20 you want to forecast forward 40 trading days. They left the low in the market down here, and now you want to what? Identify the high up here. You see that high? And they keep what? We're trending now. You're forecasting in price, and this is pretty much, this is your window. Like, so when you're on the daily time frame, and this is what I mean, yes, this is a long-term chart, but you're narrowing your perspective down to 20, 40, 60 trading days. So when I'm viewing the chart on the daily, this is how I'm looking at the market from the daily time frame, but I'm in sync with the higher time frame. What formed right here? Y'all tell me right here in this 40-day trading window, what's right here in the market? Y'all tell me in the comments, what's that right there? It's a BISI. It's a buy side imbalance, sell side inefficiency. It's a fair value gap in the market. So this is a fair value gap in the market right there. You can see in those 40-day window, they referred to it. Y'all see that? Not only they're seeking for liquidity, they create this high right there. At that high right there, it created the 40-day high. And then coming off that high, what did they do? They dropped price down into what? Fair value gap in the form of a BISI, a buy side imbalance, sell side inefficiency. They retrace it lower. 1, 2, 3, 4. Remember, they're offering discount. It's not, okay, it's not just a fair value gap. What is it? It's below the price. It retraces down to what? A discount, fair value gap. So, if they offering discount, this is your opportunity to accumulate XRP. They give you 1, 2, 3, 4 days to accumulate. And then what? Boom, bust out, take out what? The buy side liquidity above the market. They pop through it and trade up to what? This was that exciting week in November. This is when November was on a roll for us. So here we are right here, late November. They retracing price, and then boom, the next several days, this was a ride. I know I was losing sleep because it was a thrill. So after allowing you to accumulate price right here to be a buyer, they start expanding price higher, taking out the liquidity. Price is always going to seek liquidity. And then they went up to this level up here. This is that monthly level, which is the superior time frame. And they went to the midway point. Let me drop out to the monthly. That's what it looks like right there. So if you've been paying attention, I've been taking you from a higher time frame down to the lower. And I just showed you from the daily how the price reacted to the higher time frame level, which was the daily. I mean, the monthly. So you can't even see all those things I was outlining on the daily. So once we drop down to the daily, you can see it much clearer. So, okay, we defined the forecast. We forecasted out 60 trading days. So now what? We forecast out 60 trading days. We're going to look forward 60 trading days. And we're not at the end of this colored area that's green. That's the end of 60 trading days. So we already can determine what? What's the highest high and the lowest low? Boom, there go a high right there. There's liquidity. So what has been repeating? What has been repeating in these retracements right here in a trending profile? Retracement. So where y'all think price is gonna go? I mean, it's plain and obvious to me. Where y'all think price is gonna go? When price is always looking for the liquidity in the market. There y'all go. It's the liquidity above the market. So I identified forecasting forward the lowest low and the highest high in the future 60 trading days after looking back. When the market is consolidating, there will be more liquidity in the market, but now we're trending. We're coming out of consolidation. So now we're trending. This tool that I'm using, which when I'm looking back 60, 40, 20 trading days and I'm casting forward 60, 40, 20 trading days. This is called the look back and the cast forward or the forecast forward. So I'm looking back and projecting forward 120 days. It's a 120 day window. So when I'm on the daily time frame, I can narrow. I don't need to look back at, I'm identifying the higher time frame objectives. But once I drop down to the daily, I'm zooming in on price because everything that happened looking back 60, 40, 20 trading days, that's irrelevant at this point. So now I can lock in on the look forward in price. I can lock in on the current 20 trading days or the current 40 trading days or the current 60 trading days. And this is how I'm viewing the market when I'm on the lower time frame, which is the daily, which is still a long-term chart, but it's also a short-term chart. So let's say you wanted to be a day trader. Well, where does price drop down to? I'll remove that right there. Look at this gap in price right here. Inside of that weekly fair value gap. So you can start seeing the PD arrays are blending. They're starting to blend together from the weekly down to the daily. The weekly is the more significant, which is gray. The daily is in the green. So look at this fair value gap the market drops down into. It retraces down. And you can see them offering a discount inside of this daily one that also digs deeper into the weekly fair value gap. Y'all see that? Offering what? Support. You could be a buyer. Reaching for what? Liquidity above the market. Y'all hit that like button, share that video, subscribe if you're new to the channel. This is a masterclass in technical analysis. And I'm actually laying it out. You know, I should be charging for this, but no, I'm not going to do that. I'm going to get my blessings in other ways. I get my blessings in other ways because I think this is needed for a lot of people. So I took you from a down from a month and look how long it took. Now, when I'm doing my analysis, it don't take me this long. But I'm also, this is taking me long because I'm giving y'all the details behind the market and I'm showing you why this is what this is and how it works and all that. But we're just down from the monthly, weekly, and daily, which is the higher time frames. I haven't even dropped down to lower time frames. So what am I going to do now? Y'all ready to go intraday? Y'all ready to drop down to below the market? Everything below the daily time frame, we get into day traders territory. Y'all heard me say that before. So once I drop down below the daily, we're going to get into day traders territory. And remember, every time frame, you want to identify your PD arrays. You want to put them in a folder in your object tree. And you want to keep them organized because you can get lost in the sauce if you don't stay organized in your analysis. Okay, liquidity leads when selling and accumulates when buying, right? Liquidity is where the orders are in the market. Liquidity above the market Okay, for example, I'm gonna give y'all the narrative. I'm gonna get more into liquidity once I drop down to lower time frames. So let's go down to the hourly. I'm gonna go down to the hourly from the daily. So once we drop below the daily time frame, we're getting into intra-week territory. Once I drop below the daily time frame, we're going to get into intra-week territory, intra-day territory. Intra-week is what I'm about to show you on the hourly. So I'm going to drop down to the hourly. So as you can see, everything is still there that I drew from the higher time frames. Everything that price is referring to is from the higher time frame. But I'm about to remove most of this stuff. I'm going to show you how to have a perspective on the hourly. I'll remove most of this stuff right there. So what I'm about to do now is on the hourly, this is something what I call my weekly dividers. I'm going to take a vertical trend line. So my vertical trend line, where am I going to start? Pay attention. You're going to take a vertical trend line and you're going to drop it on the Sunday that just passed, which was a few days ago. You're going to go all the way to Sunday at midnight. Sunday at midnight, right there. Y'all see that? 12 o'clock midnight Sunday. I'm going to make this a little thicker. And then I'm going to clone it. And I'm going to drag it all the way to the right of my screen, all the way out to Sunday at midnight. So you can see the days of the week. Once we go from Sunday at midnight, you look at the bottom of your screen. You can see Monday midnight, Tuesday midnight, Wednesday midnight, Thursday midnight, all the way out to Sunday at midnight, the upcoming Sunday of the week. Right there. So now I'm gonna get organized. I'm gonna come over to my object tree. I'm gonna put it in the folder. And I'm gonna name it my weekly dividers. My weekly dividers. Okay, also, I forgot to tell y'all this. If you're using TradingView, look all the way over here to the left of my screen. This right above the trash can, you want to click this, you want to highlight this indicator right here. And what it's going to do is, if you don't do this, it's not going to work. But if you click this right here, it's going to sync all your drawings from different layouts. So if I go split screen and I want to do split screen and different screens, it will bring all these drawings over to another chart. And it will help, like, let's say I'm on the hourly right here and I want to do this right here and go out to the weekly. And I want to identify where the PD arrays are in the market. Well, when I click this indicator over here, it will bring all those drawings onto other screens. If you don't do that, you won't be able to see where the price is going once you do multiple screens. So that was just a little side note. But back to this right here. These are my weekly dividers. Why are they weekly dividers? These are pretty much data ranges. When I drop below the market, this helps me identify what time of the day I'm in the market, like what day of the week it is. I can also look back previous weeks. And I'm intraday. Now we're intraday. So you see all these candles? The price action picks up and the market moves faster as you drop down to lower time frames. It's still relevant to the high time frame. So whatever the price is on the daily, the weekly, and the monthly is relevant, but you can't see price. You can't see price moving around once you drop down below the daily. So what you have to do is, you can't see price moving around when you're on the daily and above. But what you have to do is you have to drop down to lower time frames and you can see how price is moving. And inside of this price action is a lot of volume in the market. There are traders in this market moving around millions of dollars, hundreds of thousands of dollars inside of this price action. So let me continue. What I'm gonna do is between these two vertical lines is this current week's trading. Y'all see this? We open up on Sunday. If you come to the current candle, it is Tuesday. what I'm gonna do is I'm gonna look back intra week, and I'm gonna take this same trend line, and I want to clone it, and I'm gonna go all the way back to the previous Sunday at midnight. And you need to set your time frames to 12 o'clock midnight Eastern Standard. 12. You need to set your time frames to New York Standard Time. How you do that? Look at the bottom of the screen right here. It says UTC 5. You click that. Wherever you're at in the world, you need to be on New York Standard Time. You need to adjust your time frame. If you're going to be looking at the markets, you need to be on New York Eastern Standard Time. New York is the financial hub of the world. And also, this is what the algorithm, that's the time frame that the algorithm runs on. It doesn't run on any other time frame. It runs on New York Eastern Standard Time. So as I throw up these dividers, you can see on the hourly, we're intra-week. You can see everything to the right of this vertical trend line. This is current week's trading. Everything to the left was last week's price action. This was last week's price action. And you can continue to do this as far as you want. Let's go back out 2 weeks ago, Sunday at midnight. So current week, last week, 2 weeks ago, and you can continue to go out. I would say up to 5 weeks. But for right now, I'm gonna go out to 3 weeks. If we're in a tight consolidation, it might even go longer. It might go out 6, 7, 8 weeks if we're in a tight consolidation. But since we're trending on a higher time frame, I'm only gonna go back out to about 4 weeks. So I'm gonna drag this one out all the way to Sunday at midnight from November 24th. So we're getting into last month's price action. Y'all see that? 3 weeks ago was last month. And you can refer back to that data or what price did in that week on a lower time frame. Y'all see that? And then we cross over into this week. Sunday at midnight starts the new week. And then we cross over. This was the new week. And what are we doing when we're doing this? We want to start looking for liquidity. Where's the highest high and the lowest low from the previous week? You say put dark mode on. I'm somebody who I don't like the dark mode. I need to see light because when you're doing analysis, you can see it clearer with light. Is it bothering anybody else? Y'all let me know in the comments. Does this chart bother y'all or wherever you're viewing it from? I can't, again, when you're doing charting, you got to make it preference for you. So some people do good at dark mode. I like the light. I like a white background or a lighter background because it helps for me to see what I'm doing better. And also, if you're late at night, whatever, it keeps you up. Dark mode is going to put you to sleep. Yeah, I prefer a light chart. Most people that you see around on social media or YouTube, they do darker backgrounds. I don't like dark backgrounds. So again, when you're doing charting, as long as you're retaining the information, that's all that matters. When you get to your own charts, you can do whatever you want to do. But right now, this is how I'm teaching it. And I done played around with the dark mode, light mode. I prefer light mode. So it's all about preference. Is when you're charting is unique to you, whatever you like. So I can't help that you're not getting it, but you might have to adjust your television or however you're viewing the market. But as long as you're retaining the information, that's all that matters. Retain it, go apply it to your dark charts. That's all that matters. Y'all let me know if y'all, I don't do light mode. I don't like it. So what we're doing, you threw me off right quick, but it's all good. What we're doing when we're doing this, we want to find the liquidity from last week and previous weeks. So if we look back to the left of this trend line right here, where's the liquidity? You want to find the highest high and the lowest low. Yeah, Daryl, like you definitely can find the, especially like gaps. If you're on dark mode, that shit gonna be harder to find the fair value gaps. And I done played around with dark mode, but I prefer the light mode. So what we're doing is when we do this, we're going to look for the highest high and the lowest low in the market on the hourly time frame. We're looking back at previous week's price action. Y'all see this? We're intraday now. We're intra-week. We're intra-week where we're looking at previous week's candles. If you could drop out to the weekly time frame, which I'm about to do right here. This is the weekly time frame. On the right of my screen, this is the higher time frame. Each one of these candles represents the lower time frame between these vertical lines. Hit one if y'all understand that. So this was the candle inside of this window of time last week. This was previous week's price action. And if you look at the weekly candle opened, it created a high, it dropped down, created a low, and then it retraced back into the range, and it pretty much consolidated the rest of the week. And if I drop out to the weekly, you can see exactly that. It created a high, created a low, consolidate. This was a consolidation candle on the higher time frame. But you can't see the price action, what happened inside of that candle until you drop down to lower time frames. That's what I'm referring to. So when I'm on the hourly time frame, I'm looking for the lowest low and the highest high, and that's identifying the intra-week liquidity pools. And remember, price is always going to seek liquidity. So let me give you a little tip and a little hint and a little secret. Every week that forms, we either going to take out the previous week's high or the previous week's low. That's guaranteed in the market. Sometimes we have a week where it doesn't, but we don't have consecutive weeks where we don't take out the previous week's high or the previous week's low. So this week so far, look what price did. I'm just going off of liquidity. I'm not even showing you the higher time frame PD arrays. I took all that off my chart and I dropped down to a low time frame, and I'm just going off liquidity. Y'all see that? I identified last week's high right here and last week's low. Where did price go today? And why do people say, oh, we broke out, but now price is retracing back down lower? Y'all see that? We took out the liquidity pool right here. And then look all the way out to the left of your screen from 2 weeks ago. Look at these two highs right here. Y'all see these two highs? I'm going to refer to them. Y'all see that? Above old highs, the market makers had their sell orders. Below old lows, they have their buy orders. So do y'all see that? They went up, took out the liquidity above the market. They offloaded their long positions. Traders. Now, like I said, once we drop down below the market, we're in day traders territory. How did they take those longs up there? Look at this fair value gap in price right here on the hourly time frame. Y'all see that? Look at this large candle right here. So price is becoming fractal. It's becoming fractal. And even on lower time frames, these same things repeat over and over again. They drop price down, drop it into the fair value gap. But the only difference is these candles are forming quicker than it is on the daily, the monthly, weekly, and daily. They're forming quicker. So this is an hourly time frame. Each one of these candles takes 60 minutes to complete. Now see that? Fair value gap. What kind of fair value gap? Discount. Where did they send it? To a premium, the liquidity pools. Y'all see that? They offload, they accumulate right here. They exit right here. That's day trading. They accumulate right here. They exit right here. Look at this high right here. This high above the market, that's that 60-day, when I was looking forward 60 days, that was that high on the daily right here. That high so happens to be the high from 2 weeks ago. Y'all see that? Now let's start blending those daily fair value gaps and that weekly fair value gap. And I'm looking at current week's price action. I'm looking back 1-2 weeks ago. So I'm looking back at least 2 weeks ago. Y'all see that? We dropped down to what? Discount. This is when the price action dropped down to $1.90. They drop down the discount and they leave the discount because that was your opportunity to buy. They consolidated the market, and then where did they send them price? Up to buy side liquidity. They took out last week's high and the high from Tuesday from 2 weeks ago, cleaning out the orders. Now, what's the narrative behind this? So there was people in the market that were shorting XRP. These short traders, they went short, they dropped the market down. And guess what? They held their positions. And what did the market makers do? They brought it back up, liquidated them right there. People that went short. Over here, from 2 weeks ago, there was buyers in the market. This was before Brad Garlinghouse went on 60 Minutes. The narrative was XRP about to break out. Let me go ahead and put a position order on just in case we break out. So you can see price was going in retail's favor. They was anticipating Brad Garlinghouse sending this to the moon. We opened up the new week. They sold it off. 60-minute airs right here on this candle right here, 7 o'clock p.m. I covered that. I did it live stream. They sell it off, and people that was going along, what did they do? They dropped price down, liquidated their orders below the market at old lows. Y'all see that, right? Down, and they dropped price down to what? The higher time frame, daily, and the weekly fair value gaps. Y'all see that, right? Which was a what? Discount fair value gap. Not just a daily and the weekly. It was a daily, weekly discount fair value gap. You accumulate. You see this low right here? They take out that low right there. Below that low, sell side liquidity. They drop it below that. They drop price down to the 50% level. And now we leave discount to what? Take out premium levels. What's the premium levels? Last week's high. These highs over here. So there's a narrative behind price action. Shout out to y'all. I appreciate y'all watching. If you're learning, y'all hit 1. If y'all learning, you're not going to get it all in one, you're not going to get it all in one lesson or one video. This is something you got to repeat. This is something you got to back test. This is something you got to do over and over and over again to see what I'm outlining to you. I just gave you narrative. If you're new to the channel, hit that like button, subscribe. So I kind of got sidetracked, but what I did was I gave you framework by showing you these weekly dividers. I just gave you framework in the market to help you identify the previous weeks, how previous weeks traded. And I just blended in the higher time frames. Again, I'm in sync with the higher time frame. So I knew when they dropped down right here, they took out liquidity. They dropped down into a discount fair value gap, which was an opportunity to buy. And then they start seeking premiums in the market, taking out old liquidity above the market, which is also a premium PD array. So since I'm on the weekly right here, what I did was I looked back 1, 2, 3, at least 3 weeks in price. Now we're caught in the range. We've been consolidating. If I drop out to the daily, you can see that consolidation. But now I want to throw up my daily dividers. I want to get more specific in the market. This was intra-week. And then once I throw up my daily dividers, we'll go intraday. So Sunday to midnight to Monday at midnight. That's how I'm going to start it off. Sunday at midnight, Monday at midnight. And remember, stay organized. I'm going to label this my daily dividers. Y'all want me to answer questions, but I'm trying to, what's your question, author? How do market makers work? How can they just inflate the price of coins? Because they got the liquidity to do it. They have the liquidity to do what they want. They control these price feeds. Nobody controls the price feeds. That's how market makers work. They're in complete control. And they also use algorithms to move price for them to where it's automated. They don't have to do nothing but program price to where they want to go. Most people aren't aware that how price action moves is very generic, but they have the liquidity to move prices wherever they want to, because they can do that. They're working with trillions of dollars. Nobody in retail can move none of these markets. That's how market makers work. Market makers look for liquidity, where retail, like in all this price action from this high down to this low, retail is just randomly buying at certain price levels. They're not buying at specific price levels, but the market makers refer to specific price levels where they're going to liquidate you in price. Like you see these old highs up here? Y'all see these old highs? What about the people that bought at these highs right here? People seen XRP moving higher and they decide, hey, I'm going to get in at a $2.65. Why not? I'm going to put $1,000 in at a $2.65 because I feel like it's about to take off. Well, guess what? You buying at $2.65, market makers liquidate these highs up here, and now you're underwater because you didn't buy at a discount. You chased price and bought at a premium. That's how market makers work. Type 1 if y'all understanding it. I'm outlining it right here in the video. See these highs? Most people are buying at any random price levels. I don't do that. I buy at deep discounts wherever I want to choose and buy price. So Arthur, I'm giving it to you right here. You got to pay attention. And if you're new, I appreciate it, you joining. If you missed anything, go back and watch the live stream. But I'm showing you by outlining where the liquidity is in the market. You see, I'm showing you how price went up there. Why didn't it? They wasn't ready because we're on lower time frames. There are traders in this market. They wasn't ready to start breaking price out. They wanted to go up there, liquidate old highs, liquidate traders that were short in the market and people that was trying to buy the breakout. People that try to buy the breakout in XRP just now at 265. Look what price is doing right now. This trend line right here is 265. Now look what price is doing. You're underwater. You're in the negative. And guess what order flow is doing? Now we're in a sell program. What's this right here? See the fair value gap on the 1 hour? Look at this right here. What kind of fair value gap is that? What kind of fair value gap is that? Y'all tell me in the comments if y'all been paying attention. We take out old highs. Market makers offload their long positions. They reverse price. And now guess what? Look what they're doing. Price is going in the opposite direction. It's most likely doing what? Trying to seek liquidity in the market. There y'all go. Y'all paying attention. I appreciate y'all, man. Y'all hit that like button, hit that subscribe button if you're new to the channel. So this is a buy program over here on a lower time frame. I was showing it to you on a higher time frame. Over here to the right, buy program. Take out old highs, reverse market, sell program. So, Arthur, did that answer your question? Okay, I see you said thanks, bro. Okay, so let me get back. I got to wrap this up. You know, I'm trying to be detailed, but I'm getting off topic by answering questions because this is supposed to be I will answer questions. Once y'all watch this, y'all retain some of it. The next live stream I do, I will answer more questions in detail. But right now, this is something that y'all can go refer to at a later date. And I'm trying to wrap it up. So I'm about to throw up my daily dividers. Again, we're going from midnight to midnight every day. So when I'm doing my daily dividers, I'm going to throw up from Monday, midnight. I'm going to clone it. Tuesday at midnight. And this is giving y'all framework and structure on how to view price instead of coming into the market and not knowing what to do and you don't really know what's going on. I'm giving you framework. So from Tuesday to midnight to Wednesday at midnight. Wednesday at midnight to Thursday at midnight. Thursday at midnight to Friday at midnight. And the crypto market is a 24-hour market. Traditional markets go from Monday to Friday. Crypto, Sunday to Sunday. Friday at midnight to Saturday at midnight. So, boom. Y'all can see this is intraday. So now, okay, when I was on the hourly, I'm looking at the market from an intraday perspective. And also, you can throw these dividers on previous week, last week. Everything to the left of this trend line was last week's price action. So you can go back from Sunday to Saturday, last Saturday at midnight to find the liquidity. So every day, guess what forms? There's liquidity below the market, liquidity above the market. Every day that completes, you're going to look for the previous day's liquidity. below the market, above the market. And you can see how we're framing up where the liquidity is in the market. This was last Friday from midnight. I'm gonna go all the way out to last Thursday to midnight. And I'm gonna stop right there because once I get past Wednesday, we get into the low of the day that happened on Tuesday. Let me see right quick. Yeah, so the Wednesday low, I'm gonna identify it here shortly. 1 second. I'm gonna go out to Wednesday at midnight. So what we're doing is we're intra-week, and we want to identify every day. We want to find the high and the low. That's where the liquidity is intraday. You're not going to be able to see this on the monthly, weekly, and daily. But once you drop below the daily, like I said, you're getting into daily day trader territory, and there's active traders in this market taking small price action movements to seek liquidity either above or below the market. And then they're done for the day. They're in and out. And that's what the algorithms are doing. That's what smart money traders are doing. They're getting in and out of this market. Even though I'm talking about the digital asset XRP, there's still people trading XRP with paper contracts. So I'm giving you the best of both worlds. If you want to be a long-term trader or a position trader or investor, I showed you that. Just go back and watch the live stream. And then I'm taking you from a long-term position trader down to a short-term trader down to a day trader. And I'm not even gonna get into scalping today. I'm just gonna take you down from a long-term, short-term, down to a day trader. And it helps to understand what's going on lower time frames so that you can identify what's the next move on the higher time frame. Because you can't see everything that's going on the higher time frame. You have to drop down the lower time frames to get closer to the market, so it can help and aid you to assist you on the next move going on a higher time frame. And it goes back and forth. You want to watch what's going on the higher time frame to help you assist you. It's a matrix. Every time I drop down the lower time frames, the market is like a matrix. It's fractal. And most people not even aware of this and how to frame it up and look at it from this perspective. I'm showing you a matrix. So you can see, I do this sometimes. I don't like doing this, but I'm gonna do it right quick. This was Sunday. And if you've been watching my live streams, I've been showing y'all how to do this. I just haven't put it all together for y'all. That was Monday. Tuesday, which is today, currently. We're about to go into Wednesday. It's already Wednesday in Asia. Thursday, and I'm gonna stop right there, and so on and so forth. Excuse me, Wednesday, not Thursday, Wednesday. And then so on and so forth to complete the week. And then everything to the left of this vertical line was Saturday, Friday, Thursday, and Wednesday. So what you're doing is you want to identify the previous day's highs and lows. So you can see already we took out, and remember, if we're looking at previous week's highs and lows, those are the more significant liquidity pools. The previous week's highs and lows are more significant than the previous day's highs and lows. So I'm gonna identify the previous day's highs and lows. You can see we rallied up today on Tuesday and took out last week's high right here. We liquidated it. Y'all see that? And then we came up and took out these equal highs from 2 weeks ago. So after we take out liquidity, it's done. You can see how price went up there. They offloaded their long positions. They actually bought down here and they held it for a week and exited at this high right here. Imagine that. Imagine making hundreds of thousands of dollars, 20,000, 30,000, 10,000, just off this price action right here that you can't see on a daily time frame. Or if you're holding in the market, you can't see that. OL, you got to get in sync with the higher time frame. I don't see us dropping back to last week's low, because if you drop out to the higher time frame, I don't see us coming back down into that daily or that weekly fair value gap. Y'all hit that like button. If you're new to the channel, subscribe. So I'm trying to wrap this up. So after we drop from the hourly, we're going to drop intraday. So when we're on the hourly, this is intra-week where I can zoom out. This is the perspective I have when I'm viewing the market when I'm on the hourly time frame. See, every time frame has its own specific thing to it. And if you don't understand it, go back and watch the replay. Every time frame has its own specific thing to it. So now when I'm on the hourly, this is how I'm viewing the market. And when I drop down to the 15-minute, 1 second. When I'm on the hourly, I'm looking back at least 2 to 3 weeks. Sometimes more if we're consolidating. So this price action right here is 1-2 weeks ago. And if we extend it to the left, that's 3 weeks ago. So about 2.5 weeks ago. But I'm just paying attention. I'm looking for the liquidity from last week and previous weeks. I'm identifying the liquidity because that's where the market is going to want to seek first. The market always seeks liquidity overall. It's going to look for liquidity in the market. So from the hourly, I'm going to drop down to the 15-minute. On the 15-minute, you already know I identified the days of the week. So every vertical line starts at midnight. So currently this was Monday at midnight. Tuesday at midnight. And as you can see, we're creeping over to Wednesday at midnight. So now we're intraday. You ever wonder about when you're watching the news and they're talking about intraday price action or whatever, or now we're looking at the market from a day trader's perspective. My perspective is I'm looking at the market from previous days. I'm looking at Monday, Sunday, Tuesday's price action. And if we need to extend any further back, we drop out to the hourly. And now you can see, okay, where's the liquidity? If you no longer can see where price action is going on the 15-minute, you need to zoom out. Look out the hourly, you can see the liquidity. But now I'm about to drop back down to the 15-minute. And when you're on the 15-minute time frame, this is when you start incorporating time of the day. You already, my bad. We got to identify the liquidity in the market. So let's go identify the liquidity first. That comes first. So here's Monday. You want to identify that low right there. See that low right there? That's Monday. That's sell side liquidity below the market. See this high right here? That was the high from Monday. Where did price go? Like I said, every day we're either going to take out the previous day's high or low. We draw it up. We drew up in price. And where we go? We took out the buy side liquidity in the market right there. Y'all see that? Boom. We opened up at midnight during London. Open up during London, we rally higher. Where did price go directly during London? Directly to the liquidity above the market from previous day, which was Monday. It targeted it. It consolidated. After it hit the liquidity, where did it drop down to? Y'all tell me what that is right there on the 15-minute time frame. Took out liquidity, retracement, accumulation, and then what? Continue higher because there was also liquidity resting above. So you got to be able to identify that old liquidity that was on the hourly from these equal highs over here. Y'all see these highs? That's where price went. It's not going to just, when you see highs that stack up, highs or lows. So when you start seeing liquidity that's real close in price, it's not just going to want to take out just one liquidity pool. It's going to want to go ahead and take out that whole pool of liquidity that's left behind in the market. Like right there. Y'all see that? So we didn't just drop. We didn't just come up and take out previous day's highs. We want to go ahead and take out previous week's high and old highs from left behind in the market. And that's what we got. Drop back down to a 15-minute. So as you can see, we come down. Take out this liquidity. That move isn't done. We're not ready to retrace and reverse. They want to go ahead and grab all those orders above the market. So what they do during London, they start going up higher. They take out this liquidity. They fell short of taking out the liquidity above the market. They retrace price. And where did they retrace it to? To offer what? Y'all see that? Now this stuff starts to print out real faster on a 15-minute time frame, and the market is moving quicker. But if you're on the daily time frame, you're not seeing none of this. But day traders are. So they retrace price, accumulation, punch price higher, take out the liquidity above the market. This isn't a fair value gap, but I'm just showing you how they're distributing, they're offloading their longs up here. They're offloading their longs above this liquidity pool up here. So they're offloading their long positions to break the market down. This high, this low, this high. Once you start seeing a low break, that's a shift in market structure. So after they offload their positions, they start breaking the market down. They start taking out old lows. Now the market is in a what? Sell program. We're in the sell program. Y'all see that fair value gap right there? Trade inside of it. It's a what? SIBI. Not a BISI, it's a SIBI. And then you can see the market start to break down, right? Y'all see that, right? Y'all go back and watch the live stream if you don't get it. Go back and watch the live stream. So let me remove some of this stuff. I'm about to wrap up here shortly. It's been a long one. This is one you want to go back and replay, watch it over and over again. So what we're doing is when we're on the 15-minute time frame, you want to start identifying the previous day's highs and lows. I just had to walk you back to show you how we took out previous day's liquidity. Price is always going to seek liquidity in the market. So Tuesday, you want to identify the high, which is right here. This was Tuesday's high. Price is going to want to refer back to this at a later time. It could be tomorrow. It could be a few days from now. And you want to identify the low. Well, there's really no low because the low from Tuesday started during Asia Monday. But you want to identify that session liquidity, which I'm going to get to in a minute. We're going to identify that session liquidity because if the market starts breaking down, it's going to want to come down to this low right here and then clean out all these lows. And if they drop below that low right there, they're going to trade into this right here, this large gap in price, if they want to drop it down there. So that was previous day's highs and lows right there, short term, 15-minute time frame. Took out last week's liquidity. And now what do we want to do? We want to start identifying the time of day. So when we're on the 15-minute time frame, we want to start identifying the time of day. Before I do that, let me go get organized. Come over here to my object tree. I want to label these previous days liquidity. That keeps me organized. And you can put the high and the low inside of that. And then this is the range we're in. So look at the current range. And I'm going to show y'all a little secret right quick. If you take a Fibonacci, and remember the Fibonacci isn't special. If you just measure the Fibonacci from this low to that high, it's going to give you the range that we're currently in. So from this low right here up to this high up here, this is the range. Y'all see that? This is intraday, 15-minute, 1 hour time frame. Where did the price go after creating this high, after taking out the liquidity in the market all the way to the left? Where did price action go? It dropped back down to what? Look at that 50% level. Y'all can't make this up. How many times did we bounce off that 50% level? 1, 2, 3, 4. And we just holding price right there by that 50% level. What's above the 50% level? Premium. What's below this 50% level? Discount. So what I did was I just measured this range to identify the premium side and the discount side. So everything below the 50% level, you want to identify where the discount arrays are. So boom, there goes the discount fair value gap right there. And then what's above the market? What's below above the 50% level? Well, look at this SIBI right here. There's a premium fair value gap right there. Y'all see that? Discount premium. I just created a range and divided it in half, and you can see how the algorithm operates. Also, look at this gap right here. Here's an inversion fair value gap. See this gap right here? We expand it higher, and then we trade through it and cut through it. Let me identify the inversion fair value gap right here. So I'm mixing all kind of stuff. It's whatever you can identify and apply it to your charts. This is an inversion. You see, we retrace to it, we cut through it, and let me remove this one right here. You can see we drop lower, we trade through this inversion fair value gap, and then look at these candles right here. It retraces, touches it one, touches it 2 times, and then rolls over. Y'all see that? So it will support, turn resistance, touch it 1, 2. If you had a limit order and you was able to identify an inversion fair value gap, you can sell 1, 2 limit orders right there and sell short. If you didn't see the inversion fair value gap, then you can use this SIBI right here. Y'all see that? Look at that SIBI right there. You didn't catch the inversion. You don't see it. You can use that SIBI right there. 1, 2, sell off. Down to what? Below the 50% level to what? Discount. Appreciate y'all subscribing. But I'm gonna go into that at a later. That's a whole teaching within itself. How I just divided this range right here, and I'm not even looking at the liquidity now. I know where the liquidity is, but I divided the range. Yesterday's low, previous day's high. Drew a Fibonacci. Now you can see the price action is trading between a premium and a discount on an hourly time frame. By dividing this range, above the 50% level, premium side, below it is discount. But I'm gonna say that for another day. That's more advanced. I'll get into that. There's a whole teaching by itself. So right now, I'm just gonna give you this right quick, and y'all might not see that. I'm able to see that, but most people not even seeing that. You see how many PD arrays I drew out on an hourly? I showed you the inversion. I showed you the SIBI. I'm showing you the gaps below the market. Here goes the liquidity from Monday. Here goes the liquidity from Tuesday. This shit gets deep now. I can get real surgical with this. Like what Denzel Washington said on training day. I get real surgical. So what I'm pretty much doing on the 15-minute, let me give you this and then I'm gonna wrap it up. On the 15-minute time frame, I'm gonna remove some of this stuff. If I remove this, you're not even aware that that's there. But now we want to start labeling my kill zones. So when we drop down, we want to label our kill zones. So what I'm gonna do is I'm gonna take a trend line and I'm gonna give you the times of day. So right now, we're trading in Asia. Asia session starts at 8 o'clock p.m. Eastern Standard Time to 12 o'clock midnight. This is the Asia session, and I'm gonna label it Asia. Your clocks need to be set to New York Eastern Standard Time. Asia. I refer to them as kill zones because the algorithm moves at specific times of the day. You don't want to just jump in the market at any random time. You want to be in the market at specific times of the day. Let me label that right quick. Stay organized. Remember, always stay organized when you're doing your charts. Kill zones. After Asia, we cross over at midnight. We go into London session. London session starts at what? 1 o'clock in the morning. 1 o'clock a.m. to 5 o'clock in the morning, 5 a.m. I'm gonna label that London. Okay. So after London session, we cross over. Once London session completes from 1 a.m. to 5 a.m., we cross over into, if you want to label this, do this. It's called pre-market New York. So about at 7 o'clock in the morning, I'm going to draw a vertical line right there. Y'all see that, right? This is at 7 o'clock in the morning, Eastern Standard Time. This is when I start analyzing the market early in the morning. I want to see what happened during London and Asia. So when I'm sleep, I'm normally sleep during the Asia hours. London hours. So when I cross over into New York, I want to be at the charts at about 7 o'clock in the morning, right here at this vertical trend line. At 8:30 in the morning to 11 o'clock in the morning, that's the New York AM session. 8:30 to 11. All right, I'm just reading the comments right quick. So 8:30 in the morning to 11 in the morning, that's New York AM session. From 11 o'clock in the morning, from 11 a.m. to 1:30 p.m., that's the lunch hour. So there's a lunch hour in the market. And these are the kill zones. Times of day that the market moves around. It doesn't move during any other time. It moves around during these times of day. And then from 1:30 p.m. to 4 o'clock p.m., that is the New York PM session. And these are my kill zones. And at the end of every day, they repeat over and over again every day. They're in the market every day. So what you do is you drag them over every day. You calibrate them to the times of the day. And you are aware that, okay, this is the time of day that we're trading in, and this is a certain time that the market moves around. And to assist me to help me and aid me to understand, okay, where we're at currently, I would drop a vertical line right there, or a vertical line. I'll drop a vertical line. And once we cross over that vertical line at currently 8 o'clock, I know I'm inside of this window in time. You will be amazed how much money is being made inside of this price action right here. And then once you start identifying the sessions, you can see where the liquidity is in the market. So, for example, I started currently in Asia, and then past 12 o'clock midnight, this is the upcoming day. But you want, after every session, you want to identify the high and the low of every session. And guess what's above and below the high and the low of every session? So this was yesterday's at midnight, Monday at midnight, Tuesday at midnight. And I'm looking at Asia session. And what I'm going to do is I'm going to identify the low, which is right here. That was yesterday's Asia low. You want to identify it. You want to refer to that. That was liquidity during that session. Y'all see that, right? Every session creates a high and a low. And in that high right here during the Asia session, it was liquidated. So I'm not going to refer to that. So we know that there's liquidity down here below the market. And let's say if they drop the market down to that liquidity pool, look over here to the right. Y'all see that? A 15-minute fair value gap inside of, there's liquidity inside of this 15-minute fair value gap over there. And then the next thing you want to do is you want to look at where's the high and the low that happened in London. So from 1 a.m. to 5 a.m. Eastern Standard Time, you want to identify the low and the high. So check it out. This was the low. This candle right here, that's the low from London. So we know, okay, if you was inside the Asia session and you wanted to scalp the market, you will find an entry somewhere in here. There's a SIBI right there. You'll find an entry and you will exit right here, taking out the London low. But also, where's the high in London? Well, the high during London formed right here, but we liquidated old highs back here and they continued to price higher. So we crossed over after London. We created the high of the day. We note that. Okay, now we want to identify the liquidity from the New York morning session, the lunch, and the PM session. So from 8:30 in the morning to 11 in the morning, you want to note the high and the low. Well, here was the low right here during the New York AM session right there. And you want to note the high. Well, the high was right here, but it's also equal to the high of the day. So I'm not even going to reference it, because if they draw a price up, they're going to blow right through that and take out the high of the day, because the higher the time frame, the more significant the liquidity. So you already can see the low during the AM session, they dropped price down. Look where it went. And look where it's currently trading. Is that random or is that algorithmic? Y'all see it drop down in price, liquidate the old lows. And now it's just consolidating at that low right there. Y'all see that? Is that random? Or did price draw directly to it? Let's say you wanted to scalp the market real quick. That's your entry right there. Look at that SIBI. Y'all see that? Look at this 15-minute SIBI. Price drops down, they retrace it. That's your entry at a premium. At a premium. So we sell at premiums. But you remember the midway point? Below it is a discount premium. Above it is a premium. Price sells off and attacks what? The liquidity from the New York AM session. Y'all see that? It's not random. And essentially what you're doing is you're going to look for the highest high and the lowest low from New York morning session, lunch session, PM session. You're going to reference it and you're going to watch how the market trades to these levels in the market. Intraday. So if I drop out to the daily, you're not even going to be able to see that intraday liquidity in the market. This is the higher time frame. So if I drop out to the daily, you're not going to be able to see all that liquidity that the market is taking out intraday. Y'all see that? Daily time frame. Current price action, you can't see the liquidity in the market. Back down to the 15 minute. As you drop down lower, now you can visually see. What's this over here? This is a buy program to the left. This is a buy program. We take out liquidity back over here in the left. And then what does the market do? Turns into a sell program. Y'all see that? Or what does retail call it? Bull market? Bear market? I don't refer to it as that. The market is algorithmic, so it's a buy program into a sell program because it's coded to do that. That's where I'm gonna leave y'all at for today. This has been a long one, so I'm gonna expect y'all to come back and watch this video. It's a long one. It's a lot of details in this. You can go back, watch this video, watch this live stream, refer back to it. This is a master class. It's really a beginner's level. It gets way deeper than this. But I dropped a lot on y'all so y'all can regurgitate it and apply it. I gave y'all real details on how to take this information, go out on TradingView, take your chart it out and apply it, and then you observe it and watch how price moves at these levels and, you know, taking out liquidity, going to fair value gaps, BISI, SIBIs, inversions, how it trades at wicks. I dropped a whole lot of information in this. So I'm expecting y'all, if y'all want to really learn this, I gave y'all framework. I'll give you a foundation and framework for free. Most people gonna charge for this. I'm giving it to you for free. And at some point, I'm gonna be charging for this. So for y'all that watch this, y'all got it for free. Because if I would had to do this, because I can go on and on, it does not stop. I promise you, this does not stop. So if I was to charge for this, and you see how much time this took, I spent so much time on the monthly, weekly, and the daily before I even got to this level. And now I need a break. So if I had to actually charge money for this, it's gonna be hefty. It's gonna be a lot of money to be charged for this. But guess what? I'm not doing that right now. I'm doing it for free. That's just my gift to the people that's following me and subscribe to me. If you're new to the channel, y'all hit that subscribe button. But this is a gift for people who have been subscribing to me and showing up every day. This is something that you can apply, and it repeats over and over and over. This is the algorithm. This stuff repeats over and over, and you have to watch it. You have to study it. So this was a gift for everybody who came, showed love today. This is you have to do it. You have to go apply this stuff. Don't be lazy. This trading is not for lazy people. So if you're lazy, don't even attempt it. This is for some people that want to roll up their sleeves and they want to investigate what's really going on behind these markets. And I'm showing you how to unlock price action. I'm unlocking price action to show you what's behind the markets. It's not what's going on. Okay, price is completely separate than what's going on with what Ripple is doing. All that behind the technology, price is separate than the technology. I'm gonna say that these markets are controlled by algorithms, and they're in control by the central banks. The central banks control all these price feeds. That has nothing to do with the technology. They can reprice these markets to whatever price point they want to. It's not. The news is already baked into the markets. These markets move ahead of the news. So I'm calling the market before price action even happens. I already know if you can identify the liquidity in the market below and above the market, by the time it drops down and take out the liquidity and then they release news, well, the move already didn't happen. By the time they release the news, it's too late. News is delayed data. By the time you get the news, it's old news. So by being able to watch the markets, watching it real time, you're not getting old news. You're getting it real time. But I appreciate y'all joining. Y'all continue to hit that like button, subscribe to the channel. This was a master class, so go back and rewatch it. I probably won't do this for a while because it's draining and take a lot of energy. But I had it in mind because I had to come over here and redo my charts. I had to switch over to a different chart, XRP chart, because I got more data on this chart. So when I drop down to a 1 minute, I like to see what's going on the 1 minute. Y'all see this right here, the 1 minute? I can get down to this level. Now, imagine being on the 1 minute time frame. Look over here. What is this? A buy program, consolidation, retracement, and look how much faster it's going on a 1 minute time frame. So this is, let me zoom out right quick. Let me zoom out right quick before I'm gonna wrap it up here shortly. Hold on 1 second. So we know that we're currently in Asia, right? We're in Asia session. We're in Asia session. I'm about to outline that right quick. We're in Asia session. I'm about to show y'all how traders are capitalizing, making hundreds and thousands of dollars right now, millions of dollars, while retail is just sitting on, just sitting and waiting. The markets are moving on a fractal time level. So this is a 15 minute. I got a model that can take me from a 15 minute, 1 minute, 15 second. It can get crazy. So let's drop down. We're inside of the Asia session. I'm highlighting the window in time, 8 o'clock, 12 o'clock, midnight, Asia. This is the price action so far in Asia. So let's drop down to a 1 minute. This 1 minute, how many opportunities was in this 1 minute time frame? So here goes the SIBI right here. Y'all see that? Price drops down, retraces, tags the SIBI, drops down even further. What's over here on a 1 minute time frame? Look at over here to the left. All lows are relevant. Look at that right there on the lower time frame. Look at that liquidity. We got equal lows right here. There goes your entry right there. Price sells off. Where does it go? Take out the liquidity. These equal lows. Y'all see that? Oh, where did it trade into? There's liquidity, but look over here to the left. What is that right there? Fair value gap. Look how dangerous and surgical this can get. Look how surgical this can get. Taking out liquidity, and this is a 1 minute time frame. Taking out the liquidity on a 1 minute. So I'm already knowing they want to buy the market back. So what do we turn into? A buy program. So watch this. I'm gonna drop down to a 15 second. Drop down to a 15-second time frame, and let's see how many opportunities are in a 15-second time frame. And this is where we're getting into high frequency trading. So we're not even scalping at this point. We're becoming high frequency traders. So it's levels to this game. I'm trying to tell y'all, I can get surgical with this, and I'm just showing y'all the surface. I'm giving y'all foundation. So after we take out the liquidity, they offload their sell positions. The market makers buy it back. You can see price. After it takes out this high right here, that's a market reversal. So we would drop down, trade higher, we retrace, start taking out old highs. Now you know the market has reversed. What's this right here? A 15-second BISI. Right there. Y'all see that? Boom. It drops down in one entry. It goes high, it retraces. Look at this candle right here. Inside of that BISI is another BISI. Y'all see that? Boom, 2 orders. Start expanding higher. All these candles take 15 seconds to complete. It expands higher, then what it does? It retraces. What's this candle right here? Y'all see that? That's a BISI, fair value gap. How many times it retraces? 1, 2, hanging out in here. What's this low right here? What's below this low right here? Sell side liquidity. Price expands. It starts to break out. What's this right here? Another BISI inside of a BISI. Y'all see that? Entry, take off. What's this right here? These are all entries. This is high frequency trading. So this is what I mean by algorithmic trading. Y'all see price drop down, touch the top of that fair value gap. Y'all see that? Y'all see that right there? Boom. Entry. Take off. So yeah, it gets surgical like that. And then when it rallies up, where does it go? Look over to the left. Look at these old highs over here. See that high right there? Buy side liquidity. What did they do? They offload their positions after going long. And remember, we only inside the Asia session. This is all the price action going on inside of Asia. And people are making billions and millions of dollars. So what we do? We offload their longs, and then what? We break the market down, and then what we do? We go into a sell model. What's this right here? This is a SIBI. Y'all see that? We retrace higher, tag the limit orders, sell off. So like I said, it can get real surgical. I'm just gonna leave y'all there. I'm gonna leave that there for y'all right now. I'm showing y'all, if you was paying attention, this is a master class. And this is right, what I'm just showing you right here inside, this is all the price action inside the Asia session right here. So this is on a 15-second time frame. If I drop out to the 1 minute, Asia is still going. Y'all noticed that, right? Not only did I sell in Asia, but I was buying in Asia. And then look what Asia is doing right now. What's below the market right here? Sell side liquidity. Look at these lows right here. Sell side liquidity. So I'm showing you how the algorithm is buying and selling both directions. And they're doing it with a high frequency. And if you're a long-term position holder, you don't know that. You're not aware of that. But until you drop down the lower time frames, and it can get real scary once you drop below a 1 minute, the frequency picks up. On a 1 minute time frame, what's this right here? SIBI, retraces in there, offer you a sell limit order, sells off. So I'm gonna leave y'all that. I'm gonna leave that with y'all right there. Y'all press 1 if y'all understood or y'all witnessed it. I want to see who all in here who just witnessed that. And I'm just, I'm kind of holding back really. I'm giving y'all a framework for, I'm giving y'all some type of framework so that you can start working with. And then once you get real scary, again, if y'all been watching my live streams, I put numbers behind this. I can tell you, like, for example, and I'm gonna leave y'all with the numbers. This entry right here, this SIBI right here, we enter at the low. We're gonna take a measurement, a ruler, and we're gonna measure from that low all the way down to this low right here. That's your entry up here, down to the low. That's a profit of 1.5%. So if you got $100,000 or $50,000 in equity, what's 1.5% of 50,000? And then you turn around, buy it back, and you're stacking your percentages up. You're not just getting 1.5 right there. You're turning around and buying it back, and you're stacking percentages. So from 1.5%, turn around, buy down there, exit right here, 1.3%. So yeah, if you said 750, hey, that's great prices. What? How long did this take? I'm gonna measure this right quick. How long did this take from this entry down to that low? What's a good 750 in 10 minutes? And you're repeating it over and over. What's 750 in 10 minutes? Ain't that a blessing where you can make $750 in 10 minutes? I don't shun that off. Yes, it's like people paycheck, and you're doing it over and over. And that's what I'm trying to show you on these lower time frames. If you learn this skill set, you can compound that up. You can run that up real quick. You can make $60,000 in a day. You can do that while you holding a position, holding long term, which I advise for XRP. But if you want to adopt day trading along with your long term holdings, then you can run cash up real quick. Like RLUSD, they're going to start using RLUSD for trading markets, for financial markets, like futures trading. And I'm going to be running that stuff up and able to send it back and forth with ease. Once they start bringing in regulations and we're able to use it for trading products, I'm going to be running that stuff up real quick and be able to send it and spend it. Like, imagine making 750 and you're using RLUSD, and you're able to like withdraw it in seconds and then go spend it tonight. So if you got a date, if you're a man and you got a date, and your girl might be like, man, let's go take a trip somewhere. And you be like, okay, baby, hold on right quick. And you go in the market, do this right quick in 10 minutes. All right, I got the money. So let's go catch the plane. Let's go catch the flight. You can do it. But I'm gonna leave y'all with that. I appreciate y'all time. Y'all go back and rewatch this one. I give a lot of details. I'm not gonna do this for a while, so if you watched it and you're here, you caught a good one. Then I'm gonna go back to regular talking about the markets, whatever. But I just know I'm not gonna be doing this all the time. So if you watch this, you should start picking up on some of the language that I'm referring to. Appreciate y'all time. Peace out.